Good afternoon, everyone. Thank you so much for joining us today at the Traders Exclusive Live Strategy Series. We are very glad that you could join us today. This is Sherry. I'm your host for today's webinar. Our expert traders today are going to talk about how you can some income producing strategies designed to work on the least amount of time. They're going to talk about how to escape the rat wheel and start profiting. And we're going to discuss combining volume and price action to understand market behavior, as well as building a trade management plan to reduce risk and optimize profit. I took one bullet from all four of our speakers. We have quite the lineup for you. Now, I'd like for you to check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. And this is also where you're going to find a recording of today's webinar. But before we get started, I have to share a quick disclaimer. And the disclaimer is that you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, recommendations are all subject to change at any time, and past performance is not necessarily indicative of future results. So take some notes. Try to hold your questions until the speaker is finished. Some of the speakers will want you to interact, so watch out for that. And I'd like to introduce our first speaker. It's Anka Metcalf, and she is with TradeOutLoud. She's going to talk to us about generate an income trading 2 hours per day. Anka is a professional futures and equities trader, market analyst, and expert commentator with 20+ years of trading experience. She's the founder and CEO of TradeOutLoud.com. It's an international trading education and services company. She's an expert day trader, swing trader, and active investor with a precise approach to daily income. Her style is daily income style trading and wealth generation trading. I think I might have messed up that sentence there. She's going to help me out with it, I'm sure.
No, you got it right, Sherry. That's right. And we're going to talk about it today. Yeah.
But you know what, guys? The most important thing is the strategies that Anka teaches in her courses and her live daily approach to trading provide you with the understanding and the tools to take your trading to the next level. Welcome, Anka.
Hi, Sherry. Hi,
Thanks
everybody.
so much.
Thank you so much for inviting me to this wonderful presentation. You guys put together such great educational seminars, and everybody's going to benefit from this. All right, I'm going to start sharing my screen.
Now, do you like to take questions during your discussion and interactions, or do you like to wait until the end?
I would like to wait until the end, if possible, but I'm going to look into the chat box just at a habit.
All right, I just made it so you can probably see it now. I think you're good to go.
Okay, perfect. So thanks so much, everyone. The fact that you guys are here spending some time with us for the next few hours means that you guys are really committed to learning. And Sherry, I forgot to ask you, how much time do I have? Do I have like a full hour or?
45 minutes, and I'm brutal with it.
Perfect.
So I just used up 3 minutes of it, so you can go to, to the 48-minute mark.
Gotcha.
Thank you.
All right, thanks so much, Sherry. Okay, guys, so today we will be talking about how you too can generate a six-figure income trading institutional moves, and you do not need to have a big trading account size to do that. And also, you may not have a trading account. There are a lot of opportunities that I will tap onto this webinar of how you can actually benefit from institutional money to trade, so you don't have to trade with your own account. My approach to trading, and especially to day trading, is just trading 2 hours and done. Trading is very consuming, and you have to give it all you've got, the best that you've got for trading, and it's into the first 2 hours. We're going to get into that into this presentation. Like Sherry said, I as well please recommend that you guys, take this information as an educational, from the educational standpoint. And I'm pretty sure you know by now that trading involves a high level of risk and may not be suitable for all traders. Like Sherry mentioned, I have been doing this professionally for more than 20 years. I have been a professional independent trader focused on equities and futures for the last 18 years. I spent 10 years in investment banking, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education company that is specialized in educating individuals how to day trade and swing trade the equities and the futures markets. You could trade Forex with it. You could trade cryptocurrencies using the same system if that's what you desire. And not only that, but we also guide traders through our services. So we do provide a trading room, active trading room to trade within the first 2 hours of the New York trading session. And we do have a swing trading program as well. I'm the designer of an institutional proprietary trading system. What this means is that I am not the creator, I'm just the designer. So I took a proprietary model and adapted it to my own retail trading account. And I needed to make some tweaks. I needed to make some changes in order to accommodate the retail style of trading. My system is not complicated, but it has a few perks to it. First of all, I'm focused on price support resistance, and many of you guys that are in here say, hey, okay, I'm focused on support resistance, supply and demand, and that's what it's all about. You buy support, you sell into resistance, but you need to take into consideration a lot of other areas that are also considered support resistance. For example, such as let's say moving averages, which are dynamic price support, Fibonacci's, etc. So I actually take into consideration 8 layers of price support and resistance into the equation, and I only focus on areas that are confluence areas. So when 2 or more areas collide into approximate the same area, that is when you're going to create a massive focal point. I have some examples for you today. I hope that we're going to have a lot of time. We have discussed these strategies into the trading room this morning, and the reason why we were waiting for a buy into the end of the day and the end of the morning into the 12 o'clock. I also have designed specific trigger times for the New York trading session because I've been trading for so long. My career actually has started in trading stocks on the investing side and on the swing trading side. And shortly after I quit my job, I decided to tap into day trading. I wanted to make day trading my income producing style of trading. Income because you're in and out within the same day. And in my case, you're in and out within minutes or within a couple of hours. These specific price zones tend to also react off of some very important timings into the market. So specific trigger times into specific price zones, and these go hand in hand. Also pay attention to chart synchronicity and correlation. Today is also a really great example where we had this present in the futures indices and also into the equities. If you're looking at the Qs, the SPYs, the diamonds, and into Russell, you probably saw that Russell was a lot weaker than the rest of the indices. And even now, Russell is down close to 1%. And we're having, for example, the Dow, which is a lot stronger, which is down only 0.29%. So you can see that when you're looking, for example, to go long or short, you have to focus on what's moving in the directional bias. So for example, if the directional bias is higher and you're into an uptrend, if your asset is into an uptrend, whether you're trading stocks or futures or whatever you may be trading, even cryptocurrencies, you have to focus on relative strength or relative weakness. So relative strength in a strong market environment and relative weakness in a weak market environment. Because if you see that the index or the ETF is moving, for example, in a higher directional bias, you don't want to short it. And if it was short, you want to short it because the institutional flow is still going to be to the upside because they're going to be looking to do what? Buy the dip. I also have a strict set of trading rules and a 10-point scoring system that enables myself and my traders to identify trades with ease. And I do specialize on high velocity moves. What this is basically on trigger points that if trigger, the price is going to go instantly higher. It's going to have that burst of energy, burst of momentum to the upside or to the downside based on the directional bias, long or short. So for those of you that want to learn more about Trade Out Loud and myself, you can head on to our website, which is TradeOutLoud.com, and you can find me on social media, on Facebook, on Twitter, on YouTube, and LinkedIn. And on Twitter, I do post some really real-time trading ideas. So head on there, make sure you give me a follow. All right, so in today's presentation, I will talk about stocks versus futures. I will talk about the advantages and disadvantages of trading different markets, what style of trading suits your lifestyle, and here we're going to talk a little bit about income producing style of trading versus wealth generation. Learn about income producing strategies designed to work in the least amount of time, and a question everybody wants to know and wants to have answered is, how much money can I make day trading or swing trading? So first of all, before we begin, September is the second most volatile month of the year. Starting with August, the market tends to go in a little bit of a cooling period per se. Market tends to be a lot more sideways, which is present right now. So the seasonality is not high for these indices to have continuation higher or even to pull back lower. They're going to be entering into the pullback phase in the seasonality within the end of September towards the beginning of October. October is one of the most volatile months of the year, is where the volume is increasing exponentially, and that is where volatility kicks in as well. It is actually the official kickoff of the last quarter of the year, which is the most traded quarter. A lot of traders that sat on the sidelines for the first, for example, 9 months are now back into the market and feel the urge to get back into the market into the end of September towards the end of October. A lot of trading algorithms are being tested throughout the months of August and September, and some of them are implemented into the market into September and October. So keep that in mind when you're seeing a lot of price swings to the upside, to the downside, and in particular, a lot of wicks into the candles. So on August 31st, as we were closing the month, I posted this on my social media. This is me, Trade Out Loud, right here on Twitter. And I was making traders aware of some things that are going to happen within the month of September and what you need to be aware of. First of all, market was closed on Monday. Yay, yay for the short trading week. We all need a little bit of R&R. The most important thing that is happening this week is the futures contract roll. For those of you that don't know, is that futures contracts do not expire worthless like options do, but they do roll into the forward contracts. But you need to roll them yourself. They're not automatically rolled. So you need to roll, if you have an active position, you need to roll it into the new contract. What this does, it opens the door for a double volume. So what that means is that there are going to be 2 contracts that are going to be trading, the December contract and the September contract, starting with Friday and for the next week. Next week, we have the quadruple witching option expiration. What this is you have all stock index futures, stocks, futures, contracts, etc. Everything is going to expire on this day. So what that means for the futures market is that the September contract is going to cease to trade at the end of the day on Thursday, and on Friday we're going to roll into the December contract. So that is when we're only not going to roll. Scratch that. It's going to expire. So from that point on, active is only going to be the December contract. We also have window dressing. That is always happening at the end of each quarter. It is an effect. It's an institutional effect that is happening. So what you need to focus on, don't buy weak stocks. Don't be a bottom picker. Okay, so if you have a stock that has been plummeting lower, I don't know, like NEO or whatever stock, don't go ahead and buy it towards the end, because the institutions are going to dump it and they're going to jump into high flying stocks. So what has been a really good performer, for example, for the last quarter, they're going to buy stocks like Nvidia and Apple, and these are just a few examples. So that means that because we talked about Nvidia and we talked about Apple, these are NASDAQ stocks. So why do you think NASDAQ is a little stronger and has a tendency to be a little bit stronger into September? Is because it's getting that inflows, because we're heading towards the end of the month. We also have 2 holidays, Rosh Hashanah, and we have Yom Kippur. usually within these weeks, you're going to see low volume into the market. Okay, very low vol as this week, right? So this week we have Jewish holiday. So this week we are expecting, and we have very low volume and very low participation in the market. Major markets remained range bound. All right, so what you need in order to succeed, you see that I've already, we haven't got into trading yet, and I already, just mentioned a lot of events that are happening in the market that you need to be aware of, so you know how to tailor your trading around these events. You need to have solid trading education, and I mean really solid trading education, because you're competing against fund managers, you're competing against algorithms, you're competing against a lot of institutions. So what this means is that you need to trade in sync with them, not follow them, but be in sync. It's not like you're following the footprints. You need to walk beside them in the same footprints and make the same footprints on the sand. So when we're following, for example, when we're following someone, right, we're always behind because you're following someone, you're shadowing, right? So we need to be in the same line. We need to leave shadows behind us. So it's very important to get in the trades at the same time and not start chasing institutions. When you chase, you're always behind, right? And you're always 1, 2, 3 steps behind. You want to be at the same pace with them, if not adjust a moment ahead of time, because remember, you can do that. Institutions may not have the capability to enter their whole position size at a certain price, and they have to scale in, but you have the opportunity to do that because we're not trading on an institutional scale with our retail account. The second thing that we need to do is have discipline. Wait for a pattern to form. No pattern, no trade. It's simple as that. And we need to have the patience to wait for these patterns to form. We have to have undivided focus. That's why for day trading, I'm allocating from 9 o'clock until 12 o'clock. I actually start my day obviously a little bit earlier to collect all my information, to trace my charts. Going to show you some tracing levels that we had for the trading session today for the open, and know how to follow directions. This is very important. Know how to follow the charts and price action. So maximum focus. I like to trade from home, and you can too. And trading from home is an income producing style of trading if you're going towards day trading, because you're in and out within the same day. If you select to be a swing trader, you may be locked into that position for 3 days or 5 days or a week or 2 weeks. And in sideways market, you can be locked in for even months. So let me give you a quick example. Back in 2015, when I was swing trading, we had a huge ranging market from 2015 to 2016 in November, when the price finally broke out in November 2016. And I was in trades actually for more than a year. So I had positions active for more than a year. Now, looking back, I kind of love the fact that I was in trades. I've added to some trades on the breakouts. For example, NVIDIA, I picked up at $36. I still have it, and that is in my long-term portfolio. Remember, there are different options depending on your needs. If you're, still have a full-time job, you can opt for swing trading or investing, or even active investing. Or if you desire, you can go into day trading if you have the time to day trade. So I like to day trade, like I mentioned, with the institutional money flow. I focus on high velocity moves for high rewards. I day trade from 9:30 to about 11:30 a.m. Eastern. I like to kind of quit around 11:30, but I still watch the market to see if there are any possibilities for the afternoon trading session on higher time frames like we had yesterday. We had a move of about 100 points as a short squeeze into the Dow yesterday. So we picked it up at 100, and it went to 180 was our 150 was our target 1, 180 was at target 2. It went about 6 points shy from 200, which we trailed at 80. I like to trade 2 hours and done for obvious reasons. Like I said, it's very consuming because it's so super focused. And when I trade, I'm totally in the zone. There's no phone, there are no pets, there's nobody around me. The door is closed. And I'm 100% dedicated to charts because this is my work day. So my work day consists in being at the computer for about 3 hours. I deploy precise strategies at specific times and locations, and I apply simplified management to my trades, which means that I know exactly what's going to happen, what the steps that I need to take. For example, when I achieve target 1, I know exactly what I'm going to do when I achieve target 2, how I'm going to lift my stop, and how I'm going to trail. And you need to have that really well simplified. You need to have it like on autopilot, like a really well-greased machine. So you don't leave space for questions like, okay, what am I going to do now? Okay, so you don't want that when you're trading. In trading, you either see the pattern and you take the trade, or if you try to force a trade, and if you squint at it, if you really, kind of like, you could feel like when you're forcing a trade. And this morning, I was watching candlestick by candlestick. At one point, I mentioned in the room, say, hey guys, you know what? I feel like I'm going to be forcing a trade because there's too much effort. Trading has to be effortless, and trading is stress-free. And that's what we do every single day in the trading room. And I teach traders how to trade stress-free every month. There's no average in trading, because you know what happens if you're average in trading, you incur losses. You're either really great or you're losing money, and you want to opt for being the great, and you have to be informed, you have to be educated. What I trade the Dow, the S&P, NASDAQ, and Russell on a day-to-day basis, not necessarily all four. So for example, today we had trades in the Dow and we had trades in NASDAQ. And for example, I called a trade in S&P, but it didn't trigger. So I called a trade in Russell that, no, okay, here it is. I took a trade in Russell, but I stopped out today in the trade in Russell. And then I had trades that worked in the Dow and in NASDAQ. Also, I trade energy. So for example, I'm going to share with you in just a moment, some charts and some levels that we're looking at in crude oil inventories. In crude oil, oh, by the way, tomorrow, I was meant to say crude oil inventories tomorrow, so the price may be a little bit range bound going into tomorrow, because usually it's scheduled for Wednesday at 10:30, but because of the long holiday weekend, we have it tomorrow at 11 o'clock. Natural gas, by the way, peaks into $5. We had a high, you could see it right here, the high $5 for the trading session today. Wow, I mean, it's great if you're in a trade, but if you're not in a trade and if you're a consumer, $5 for natural gas, yikes. I mean, that's not going to you can expect a really high price bill this winter, right? If you have natural gas as your heating, let's say, commodity. All right, heating oil and gasoline still flat. Like I said, we're waiting for inventory numbers. You could also trade softs like cocoa and cotton, orange juice, coffee, lumber. These are all for swing trades, and mostly for swing trades. And especially, if you're looking at gold and silver, they have a lot of volatility still in them. By the way, they are into a retracement pattern since last year. So since last year, they haven't had a good rally, or they're back into a pullback area. They're trying to decide whether higher or lower from this point on. Silver is into the same boat. You could also trade metals like copper, for example, palladium, platinum, etc. You could trade meats like live cattle, fetal cattle, lean hogs, grains, like soybeans and corn and wheat, etc. And you could even trade currencies like the dollar or the yen, or the euro or the Swissy or the Aussie, etc. So trading is a rule-based system. You have to understand that you need to have a really good system in place. It's not sophisticated, and the simpler you have this approach to trading, the easier it is. So have a piece of paper right beside you and create your own rules and say, hey, you know what? I'm going to be trading anything that comes to me. For example, whether it's a stock or futures index or commodity or whatever it is, or Ethereum or Bitcoin or whatever it is, and make this rule that, hey, I'm going to buy any kind of pullback that comes back into the 20 simple moving average, and then it rotates from that point. So I'm going to be looking for this, let's say, strategy for this type of pullback, and I'm going to look for it. For example, if you're a day trader, focus on the 5-minute, because it's not as aggressive off 2 minutes, or you're not going to stop out as often. It is not as wide of a time frame as the 15-minute, where you would have to wait a lot of time. So it's kind of like a really nice medium point to start off with the 5-minute. And also, you're going to have pretty good, decent stop loss levels in that, and positions for that. The other thing is that, so after you decide upon the strategy, say, I'm going to take a pullback into the 20 simple moving average. I'm going to wait for a rotation at that point. This is going to be, my entry is going to be above the 20 simple moving average. My stop is going to be below the 20 simple moving average. Just simple strategy. And then wait for the targets to meet. And then the next thing that you need to do is say, hey, I want to know how am I going to react into target? So plan it. So for example, if I achieve target 1, do I want to grow my account? Because if you want to grow your account, take target 1 and done. Because a lot of times, traders wait for target 2 and 3 and 4 and 5 and 6 and what have you. In a strong directional bias, when you're having a strong uptrend, yeah, it can move for you. But in a day like today, you're very lucky with the target 1 or 2. So the goal of beginner trader is to get into a winning habit, because that is encouraging. If they see the system that is working, take target 1 and done. If you're a little bit more advanced and you're past that accumulation phase where you want to grow your account, and obviously you still want to grow your account, but you want to go towards target 2, and you can implement this, let's say after 1 or 2 months of taking target 1 and done, move towards that target 2. So what I do recommend, and what I do on a personal level is that I take, half the profits at target 1. I try to raise my stop as close as possible to a break-even level as soon as I see some kind of support development into the area, and then I wait for target to achieve. And when I hit target 2, I take another quarter out, because I divide my position size in 3. So at target 1, I take half. I target 2, I take a quarter, and then the rest of my quarter position I trail further into targets. It can go beyond target 3. So if I hit target 3, I'm not going to take my profit, but I'm going to raise my stop to target 2. So I go from stage to stage. So this is what it means to have a rule-based system. It's not complicated. You could do it in half an hour. Then finding high-odds trades. High-odds trades are coming from strong technical patterns. Then you have to wait for a setup, and you have the patience to wait for that pullback that I mentioned before into the 20 SMA, for example, and that rotation to happen. You want to see, let's say on a pullback, you have red candles that are coming in, and then you want to see the flip to the green side. And as soon as you have a little bit of green that is taking out the prior red bars high, boom, that's your entry. So it doesn't have to be complicated. And then you have to fine and precise execution, just like I said, based on these rotations. You have to have a really good money management skill in place. You have to know exactly how you're going to trail into target 1, target 2, just like I mentioned. It's not complicated. And then you need to have the patience to wait for the pattern. Don't get in, jump in, and never jump out. Think about that chase analogy that I made. Only when you hear the word chase, it's like, oh, that's a bad connotation. All right, so why futures? Why navigate to futures? Because I've been trading stocks my whole life for over 20 years. Why did I make the change to futures? Well, it was a recommendation on part of my accountant, because I was paying tons and tons of taxes for my stock trading. And futures has a different taxation. So you can do it on your own, or you can ask your accountant about futures taxation. You're going to see that you have a plethora of advantages to trading futures. And that's when I made the switch. You could take on a short position with these. You don't have the uptick rule. You have the advantage of the buying power. So definitely, I'm going to show you an example in here. You have reliable volume. You're trading major markets. You're trading the Dow. You're trading NASDAQ. You're trading the SPX. It is an income producing style of trading, because you can day trade it. You're in and out within the same day, or within minutes, or within hours, depending whether you're trend trading or scalping, etc. And it's a wealth generation. For example, if you're wanting to be an investor in gold, you can trade gold or silver or oil. For example, I had a position in oil since last year in USO, actually not in crude oil futures, but in USO. And I picked it up when before the 8-to-1 split last year, and it's going really well. Let me tell you this, it's going really well, because I picked it up at $4 equivalent, then to I think it was to was it 4 times or 8 times? I can't remember exactly. So anyways, it is trading into the upper, I believe it's right in the 40s, or I forget, I think it's like 48 or something. All right, so tick values and price ranges different. They have different values. For example, the smallest is the Dow, where you have 1 point, which is equivalent for $5, and it goes as far as 1 point in S&P for $50, and also for Russell, also for $50. You have the big advantages that now you can trade micros, right? This is the biggest thing that came to the market. You could trade micros, which are 1/10 of the size of the full size contract. You don't need to have a gigantic account to trade futures right now. Micros are fantastic, 1/10 of the size. You have micros for indices, you have micros for crude oil, you have micros for gold, and now you also have micros for bonds. But I'm trading off the Thinkorswim platform, and they're not yet available for us, not yet. All right, you don't need a scanner because you're basically focusing just a few charts. You saw the panel, no special indicators. Like I said, search tax advantages for futures. You're going to be surprised at the tax advantages. You may want to take a second look at that. There's no pump and dump, it's safe from rumors, no manipulation, no downgrades, no upgrades. And guess what? It's a 24-hour market. It's a hands-on risk. So for example, if I decide to take a trade today, let's say now, NASDAQ long, and if I decide to close it at 9 o'clock at night, I can do that. So that's a huge advantage. The other thing is the account size, and one of the reasons why many traders gravitate towards futures trading is the relatively slow startup cost. Because, for example, it usually requires about $30,000 to open a stock day trading account, and you must maintain at least $25,000 to keep your day trading status. Well, the futures market allows you to open an account for as little as $5,000. And best of all, you don't have to maintain that amount. Well, as long as you have sufficient cash in your account to cover the margin requirements to trade the commodity or even the index that I mentioned, one of the micros, you could actually have a balance of $700 to $800. And guess what? They're still going to allow you to trade futures. So I'm going to show you a quick example. So for example, if a trader wants to buy right now the Qs, let's say they're priced at $365, they need about $14,000 in order to buy 100 shares because, and by the way, and if they move a penny, they make $50, right? Because for each cent that is, cent that is $1. But if the trader wants to trade the M&E NASDAQ, let's say they're priced at 15,100, right? The trader needs about $17,000 to buy one contract because of the 2020 pandemic volatility, and it's still high. So that's why you still have a lot higher margin requirements for it, but they fluctuate, so they go down. Remember last year when oil went negative, first of all, it wasn't not even tradable on the Thinkorswim platform. They wouldn't allow us to trade it. But it had a margin requirement. I think it was about $50,000 at one point. I took a snapshot of it. Okay, so now it's way down. So for each point in NASDAQ, 1 point in NASDAQ is $20. Okay, so if you make 50 points in NASDAQ, which by the way moves like crazy. So today it was down more than 130 points. Right now it's back to down only 69 points. So you can see that it's moving a lot. And 50 points, that is $1,000. So let me show you here. So I did this little experiment earlier this year, and we used the same strategy to get in the Qs. We used the same strategy to get into NASDAQ, and we used the same strategy to get into the micro NASDAQ. So using the same buying power. So you can see here the buying power was around $16,000, and we used 100 shares just to make sure that we accommodate the 16,000 buying power. And the price went up. And you can see here, usually the trade duration is no more than in the first 2 hours in the morning. So actually in this trade, the trade duration was 20 minutes. So in 20 minutes, the Qs went up. And you can see it right here, $273 with 100 shares. While at the same time, we were trading NASDAQ. Look at the buying power, very similar buying power, 17,000. One contract, $2,000. Same strategy, same time, 20 minutes. But wait, there's more. Micros. So for those traders that say, hey, you know what, $5,000 is not going to generate a lot of money, well, think again, because there are moves, and if these moves are happening in the market, you can take advantage of them. The buying power for the micros was $1,700 with one contract. That is $181. That's about 10% of a $5,000 account. Now, should I remind you that hedge funds usually yield about 5 to 6 to 8% per year? for their clients. And this is per trade that I'm showing you. So the reason why I trade the first 2 hours in the morning is because I like to focus on the overlap of the London session and the New York trading session. So this overlap is happening from 9:30 to about 11:30 when the market closes in London. And this is considered the sweet spot. So this is where I love to trade the Dow, the S&P, and NASDAQ. Market timings and trading the sweet spot. Well, as you know, the market opens at 9:30. Aggressive trades happen from 9:32 and 9:35, and we do have a strategy for that. And no, it's not aggressive in the sense like, oh my gosh, it's going to create a cardio for you. No, it is actually a really sweet strategy to have in your trading toolbox. 9:45, we have a trigger time that is popping up, so we have decision as well into 9:45, 10 o'clock as well, so you can see how my morning is really active, and it keeps me on my toes, but I'm giving it all there is because this is my work day. So basically my trading, not only my trading week, but I only work 10 hours a week. So the markets close at 11:30 and I'm done 11:30 to 1:30 doldrums. But like I said, there are cases where, for example, yesterday we had a trade that went beyond 12 o'clock. So guess what? I'm not going to say no to money. So morning patterns that work 80% of the time. Typically, you're getting a move, whether up or down. So for example, here I have it for the upside. Typically, you're having a move from 9:30 to 10 o'clock, and at 10 o'clock you're getting a pullback. Depending on how shallow this pullback is, if it's not revisiting the 9:30 low, the continuation is going to be from 9:30 to 11:15 or 10:30. So trades that are happening in the morning at 9:32 or 9:35 are really quick trades in and out, and trades that are lining up around 10:30, which is a prime time trigger time for us, they're likely to continue for an hour. So you're going from minutes to hours, and sometimes the market is very choppy, and sometimes you're waiting for a breakout, but nonetheless until the market calibrates. And sometimes this happens in a high volatility environment that happen from 9:30 all the way to 10:30 or even 11 o'clock or even PM session if you're having really high volatility like we had last year during the pandemic. So time flexibility is, when it comes to time flexibility, the futures market is not only for day traders, but it's for swing traders alike. For individuals that have full-time jobs can also look at the markets in the evening session, and they're considered swing trades because you will initiate the trade, for example, that evening, and you will collect profits the next day or in the next couple of days or even weeks. Guess what? Geopolitical events don't wait for the market to open. Events just happen. And guess what? If you're trading the futures market, the charts are there, alive and reliable volume that you can act on. So the next question is it easy to succeed in trading? It is not hard. Guys, if you're losing money right now, guess what? There's somebody on the other side of the trade. You could make money. So it's all a matter of keeping and going at it, improving yourself, and just make sure that you're revisiting the process, the strategies, the management, the mindset, and of course you need to have the experience into the market, and of course the attention to detail, because trading is not hard, but it's not easy at the same time. Okay, so it's simple, but okay, but it's not hard. Let's say, because trading is a system, and you can't trade without having a good mindset, without having a good management system in place that will allow you to use a good risk, to use a good risk to reward ratio, to use a good strategy, a reliable strategy that has worked for other traders, for example. So keep at it, you're gonna get there. So before you decide to dive in and swim with the sharks, you need to know who the sharks are. The sharks are institutions, and the institutions know exactly where you have your orders, because there are companies like Robinhood that sell your orders and your entries, your stops, everything that you have set up to big financial institutions. So for example, Citadel, you know who Citadel is, I'm pretty sure you know what they did with GME and with Melvin Capital. All right, so experienced traders, they have no fear because they know how to ride the waves into the market. So if you want to trade, my question is, do you want to trade with or against the currents? with or against the sharks, right? Well, guess what? I want to trade with the big whales. I want to trade with the big sharks. I don't want to be chewed up by sharks, right? So you want to trade with the big institutions. Don't try to outsmart the market. Guys, these are some of the most amazing traders, and they have the most sophisticated trading systems and trading patterns and trading systems that they use. So you're either trading with or against funds, institutional traders, portfolio managers, big prop trading companies, market makers, hedger, algos, etc. So the next time you want to jump in and trade, think about this. 10% of the traders make money from the rest of the 90% of the traders. Because this trading was easy as getting one book or 10 or 50 books from Amazon, and a great indicator that you can find on the internet and say, wow, you know what, I'm going to Google an indicator that is going to show me where to get in and when to get out. There's no such thing in existence. I could tell you that. Rest assured, I have tried everything. I try to simplify my trading as much as I could, and I went back to the basics. And everybody would be a millionaire right now. The only problem that a lot of traders are having right now is that they have the information. So guys, if I ask you right now things about technical analysis, you are going to be surprised of how much knowledge you have. The only thing that traders are lacking is how to put all the information together. And this is where we come in, and this is where we help traders put all the information together. So why futures? Well, first of all, it's an income producing style of trading. It is a recession depression proof skill. And yes, it is, this is very important. To have in your toolbox. It's skill that you need to have in your toolbox. What if there's another lockdown? Like, I'm not saying there's going to be another lockdown, but what if I have clients that are in Australia, they're in lockdown. Okay, so they're relying, to provide for their families through trading. So can anyone make money? Like I said, if you lose money in trading, you can make money in trading. It's all a matter of mindset. It's all about education and how you put how to put the pieces together. In trading, you should only have 4 outcomes. You either have big wins, small wins, break-even trades, and very small losses. We trade live every day with a highly successful system that follows institutional money in the first 2 hours and enables us to profit on momentum moves at specific times, locations, precise technical patterns. And our method overrides any kind of news event, artificial indicator, earnings, and even dark pools. Here's some reviews. You can have some on our website. I'm not going to go through them right now. We have tons of reviews. If you come to a trading room, you're going to see, and you can talk to all of our traders in there. So if you want to trade an institutional grade trading system, we can teach you how to trade stress-free and learn about institutional levels, learn about precise buys and sell zones, risk management, odds patterns, etc. And we're going to teach you about putting the puzzle together. So this program is for you if you're losing money in the market, if you don't have a trading system, and if you don't have a good trading process that eliminates emotion, and if you lack confidence in the system. This course is going to change your life. We do have a course that we teach it every month, and it would be amazing to teach you how to enter trades, how to react into certain key levels, how to have access to this institutional trading system, how to have less stop outs, and where to place your stops so you don't get dinged out of trades all the time, but the stops still occur, knowing your risk level, etc. So this system teaches you when, where, and what to do. It teaches you advanced risk and money management. It teaches you advanced technical analysis. It teaches you everything from A to Z. So you come with zero knowledge, or even if you have knowledge, come here, because you will see how many light bulbs you're going to be having. And this is literally everything from A to Z. It's not me that I'm saying it. It's all of the reviews that we have been receiving, all of them 100% 5 stars. So in this course, like I said, you're going to learn, the 6 major disciplines. You're going to learn technical analysis. You're going to learn about how to maximize gains and minimize losses, market timing, because the market right now is in a cycle 3. Is in a stage 3. What this means is that into a decision stage is not bearish and it's not bullish, but it's coming from a bullish bias, so it has more than 55 to 60% odds of snapping back up. So that's why the market is having a hard time pulling back right now and selling off. and so much more. So you could go to our website and you could actually learn more about our course. I don't know if I have time until then. So we do have an early bird special. The Power Income Futures Day Trading course tuition is $4,997. The regular price, if you go to our website under, I'm going to share with you right. I'm going to share it with you right now. It's $5,999. So we're taking $1,000 off the price. The next course is October 18th through the 22nd. It's a 5-day course from 2 p.m. to 4 p.m. Eastern. The classes are fully recorded. And if you miss the classes, if you need extra help, and let's say you have a full-time job, say, hey, I can't be there at 2 o'clock, no problem. You will have the recordings, and more so for those of you that are missing the classes, the live classes, I will make time to accommodate some mentoring sessions for you guys. So make sure that you understand everything, although everything is very self-explanatory. The link to the website is TradeOutLoud.com, and actually this /futures now. So if you want to head on there, this is the link. It's going to take you right there. It's futures trading. Okay, so you could see here that it's $5,999, but with this link right here, it's going to take you to the discounted price. So thanks so much, Sherry, for having me here today. I really appreciate it. Thanks so much, and hope to see you again soon.
Thank you for being with us. I really appreciate it. I did put that link into the chat so everyone could see it. I want everyone to know that you'll be getting, you'll also be getting email from Anka in the next few days about this. So if you didn't get a chance to look at it right now, then you should be able to get some follow-up on that. So thank you so much for being with us. I always enjoy it.
Thanks so much. Thanks for having me, Sherry.
Have a good day. Thank you.
Thank you. Bye.
All right, everybody. That was Anka Metcalf with Trade Out Loud. You have the link there, so you should be able to take advantage of taking a look at that program. What a great savings. Our next speaker is, I wanted to let you know, you can, if you have to leave early, you can see this as a replay, and it'll be posted here at tradersexclusive.com/archived_webinars. And when you get to there, that will take you right to the page. If you go to tradersexclusive.com, you'll go to trading education webinars over here to the right. And then once you get there, you'll see the list of all of our upcoming webinars. Our next one is September 22nd, and you just click on here. And from there, you'll see all of the webinars that we have had in the past couple of years now. And our next speaker is coming up, Norman Hallett with the Disciplined Trader. He's going to be talking about the black hole of trading, where it is and how to avoid it. And I just want you to know that Norman Hallett has a trader and trading educator, has been a trader and trading educator for over 4 decades. You look pretty good in that picture there, Norman. Thanks. He's done everything from running one of the largest options firms in the country to being an options specialist for Payne Weber. But if you ask him what he's most proud of, he's going to say that it's being the torchbearer for modern trading psychology. From his 4-minute drill for traders with over 2 million views to his books on how to build trading plans, he's dead set on getting traders to make trading psychology a trading priority. I think that is so important because I think our minds can really do a number on us if we don't know how to keep them in order. So thanks for being here, Norman. How are you today?
Thank you for having me, Sherry. Can you hear me okay?
I can. Let me just, I think, are you getting a little feedback from me?
No, I just got a little blip that said that asked if I was trying to speak, but I think it was because I was unmuted for so long without saying anything. I don't think I've been that quiet for that long in years. But speak, does that woman take a breath, Anka? I mean, does she take a breath?
She's got it going on, doesn't she?
I gotta tell you, I wanted to start. I guess you can see my screen here.
Yes, I see the
All right,
black hole of trading.
okay, great. But before I start, I wanted to just say something special about Anka because
Oh, your sound, there's your sound is back.
okay, because I specialize in the trading discipline and keeping traders with their heads together. I partner with a lot of different traders who sell systems for the most part, and I'm going to go through a little bit of that here, talking maybe about the dark side of it, but on the bright side of it, Anka is one of those people that she is into helping you. She is a trader. I mean, I don't know if she was born a trader. I don't know if her parents were traders, but this woman can trade. And I'm saying to you, because you're going to see a lot of people, and there's some great ones following me too. But Anka, and one of the things that you can tell about a great trader is their recognition of mindset. And I only caught the last 15, 20 minutes of Anka's presentation, but this is typical of her. She mentioned the word mindset 6 times in the last 20 minutes of her presentation. So, to me, that tells me that she knows the truth really about what it takes to trade. Not only going back to the basics, where she always winds up after her presentations, because that's where the winning is, the technical basics. But it's also about marrying it with the understanding that you need to have that mindset. So that's enough about Anka. You had your time, Anka. Now I'm going to have mine. But I want to
take it away, Norman.
Okay. I wanted to talk today about the black hole of trading because, the black hole is something that most traders, the majority of traders, get caught into. And I want to describe exactly where that black hole is and how to avoid it. But before you can avoid something, you have to know where it is, and I'm going to go through that. I don't go over 39 years when I talk about my experience, because it does make me seem old. That picture right there was about, I got to admit, it's about 8 or 9 years ago. The other picture was about 7 or 8 years ago, but I look exactly the same. And I've written several books on how to build trading plans. These are the most recent ones that are still, I believe they're all still available. Actually, the one on the left here is that's really one of my presentations at the expo. They usually have me first because I run around the stage. I'm like the little Jewish Tony Robbins, where I just run around and I try to get the energy up, because traders can tend to be so enamored with the statistics that they forget about what they have to be mentally and emotionally. And so I try to help them recognize that with my presentation. Well, that was one of my presentations. This is probably my favorite book. It's still available, Inspirational Quotes. Sherry mentioned that I've got a couple of million views of what you see down here, 4-minute drills for traders. It's a couple of hundred of them. And I had one person on my team went through them one time and picked out 100 quotes that she thought were terrific from it. And I said, why don't we make a book out of it? So it's kind of like a coffee table book. But really, I've written several books on constructing trading plans, because I think if you keep them simple and you stick to the basics, that's where the truth in winning lies. All of these avant-garde things tend to have their day, and then all of a sudden they stop working and you wonder why. Sherry mentioned I worked for Payne Weber. I was a commodity specialist for them. I ran a very large option group before that, the International Trading Group. And then in the early 90s, I decided, why should I be making money for all of these people? I can be doing exactly what I want, helping people and making a little bit of money with my own outfit. And so I started managing money for rich people in my own commodity trading advisory, and cleared through my own IB so that I got the commissionable assets too. So there was a time where it was all about helping people and helping myself at the same time. But now the phase in my life really is about helping traders to be disciplined, because the 90% of traders who are not as successful are those that pay little or no attention. And So the question really is it true that 90% of traders lose money? And when I say traders, I'm talking about equity traders, futures traders. I mean, it's it's almost impossible to conceive of the fact that the majority of traders in the stock market are actually losing money, and it's true. Even with the stock market having really pretty much gone up nonstop with a couple of giant blips for the last 12 years. But if you look at monthly or yearly statements of equity traders, the majority are losing. Futures traders, like Anka mentioned, that's where I spend most of my time, even though what I do affects all kinds of traders. Forex is something that got popular because you can get in an account for $500, so that you can lose more quickly there. And the options, I'm a little facetious, but Forex also has terrific opportunities. I love the fact the volume that it trades and so on. Options, there's a little bit more knowledge that it takes there, but options can be a little bit more forgiving to you. But it doesn't matter what kind of trader you are, 90% of traders lose money. And this is the black hole. There are 4 studies that show that 90% of traders lose money. You wonder, is it true? Is it just fiction, or are they just trying to scare me to buy their next trading system? So what I did is I spent the better part of a day and a half doing nothing but searching the internet for reasonable studies that were based on reasonable things that gave me an idea of whether it was true. And I'm going to show you the 4 that I found. There are a few more, but they did things that didn't make sense to me. Like they only had 10 accounts they looked at, and certain things. And I'm going to show you the studies that I did accept as with a certain size and a certain credibility. The first one is the North American Securities Administration Association. So started in 1919, so it's 102 years old. Small group of state security regulators had a big idea: form a network of colleagues to work together for the protection of investors throughout North America. Today, this group is made up of United States, Canada, and Mexico. Who knew that? Who knew? North American Security Administration Association. And what they did was take a look at trading firms. They voluntarily asked trading firms to give up, black out the names and addresses and phone numbers, but show me the results of all of your traders in this particular category: futures, options. And what they wound up uncovering in these, as a conglomerate with all the countries on all the exchanges, was that 88.5% of traders lose. And the majority lose most or all of what they've now, somebody who opens a $5,000 account, I've learned that generally $5,000 accounts, unless it's the 5th $5,000 account that somebody's opened, tend to lose fairly rapidly, because there's just, you're too much up against it. It's hard to keep your risk in that 1 to 2 to 2.5%, and I shouldn't even say 2.5, 1 to 2% level per trade, and still be able to maintain that in a $5,000 account. Although you can do it, shares are a little bit easier to do that, but not when each share is $1,500 or $3,500, whatever Amazon is today. Here is the second study: European Securities and Markets Authority. This is really the European regulator. This is an independent European Union authority that contributes to safeguarding the stability of the EU's financial system by enhancing the protection of investors and promoting stable and orderly financial markets. Gosh, I wish we had one of those here in America. I think we do, but doesn't sound as good. In any event, this one was this actually was where they actually voluntarily and by force, in some case, went in and took a look at individual firms and rated them individually. The best firm had 2/3 losers, 68% losers. The worst was in the had 89% losers. But the fact that it was voluntary in its nature, was a little bit suspect, but still, even if so, I'm looking at their results of 76.3% losers as something that if I was trying to show my best face and I had a transactional firm, I would give them all of the good accounts. And if that's what they came up with, 76%, I got to think that maybe if they walked in there in the middle of the night and looked at every file, it may be closer to that 90%. But let's keep going. The National Securities Market Commission. This is this is Spanish, strictly Spain, but they did a very, very interesting study where they went into firms and they looked at all the records, and this was actually it resulted in not a report, but it resulted in a law that said that the result of this study was a law that said that if you advertise for these transactional firms, if you're a transactional firm advertising to put your money with them and trade, you had to say in bold print, even in the most reduced form of risk disclosure, that you were going to lose. You had the chance of losing 89%. So we're getting a little bit closer on the average now to that 90% that we all hear about. But this report, even though if you were to look this up, and I hope, for you engineers out there, and about a third, or every time I make one of those a live performance, I always ask how many traders are engineers, and usually about a third of the hands go up. You may want to dig in and look for this report. It's a Brazilian Stock Exchange report. If you just look for it, you'll probably find it. But I like this report. The Brazilian Stock Exchange is the third largest volume-wise in the world, so it trades a reasonable amount of shares. These three people, Fernando, Rodrigo, and Bruno, are some of the top traders, individual traders in Brazil. They went ahead and went after this study, and what they found was that the vast majority, more than all of these reports in the past, are losing money. In fact, the 1.1% of traders that actually make money are only making money on more than a bank teller in Brazil, which is about $50,000 a year. Their general result was that 97% lose money, but of the 3% that make money, almost 2%, 1.9% made less than $50,000 a year. So this is pretty good proof. I think it is proof, and I think you would agree with me. And you can do your own study, but I can't spend more than a day and a half looking for this, because others have done it before me, and they haven't come up with at least this Spanish security market law that I thought was important, because it wasn't a voluntary thing. I want you to look yourself. 90%, let's just say that 9 out of 10 traders lose, and the majority do lose everything. I'm talking about traders, not investors, okay? So most people know that most traders lose money, and we thought, now we know. Okay, so my question to you is, why is it so popular? Why is trading still so popular? And normally I would go to the chat right now and hear your thoughts. So let me just be quiet while I take in your thoughts through brain waves. I can hear it right now. Because I'm limited in time. It's kind of an hour presentation. I'm cutting it to 45 minutes. There's really very little regulation when it comes to advertising. That's one of the reasons why we continue, why traders, knowing that you're likely to lose, why new people and people who continue to blow out accounts and try again, why do we keep doing it? Well, there's very little regulation when it comes to advertising. As long as you use the words like can, this can be yours. This can be you. And phrases like, it's possible to triple your money in 2 weeks. As long as you're putting the dream out there, this is what, and at the near absence of a risk statement, it's like those car statements at the end where you hear somebody talking 20 miles an hour and you can't understand them. there are rules that the risk disclosure has to be the same size type that the main body has, but it doesn't say that you can't put it way on the bottom and off to the side. So there's always getting around the rules. Advertisers advertise to convince you, okay? And so if you use magic words like it's possible and this could be you, and you put that boilerplate on the bottom, trading futures or trading options is risky and only risk capital should be used, past performance is not indicative of future results. I mean, I know anybody in the business that's delivered anything around this industry knows these statements by heart. I used to, in that large option firm I mentioned to you, when my office was in the middle, and to the right of me was the corporate attorney, and he showed me a lot of the things that they were able to do that actually surprised him. As long as you do these two things, you're good. So the combination of unlimited promises and limited mention of risk is really just giving you the answer to your dreams. But look, advertising is advertising. You got, people have to make a living. Doesn't have to be at your expense generally, but listen, this is really a buyer beware industry. This is something where we as traders have to wake up and see what they're doing to us, what's happening here. Okay, so it's okay. I understand that it's advertising. It's on us. It's like one time shame on me, next time shame on you, next time shame on me. Well, if you've blown out 7 or 8 accounts, it's likely not your trading system, because and I'm gonna explain that a little bit more in a second. But here's reason 2. The trading system, a trading plan, doesn't match you. In that book I showed you, that green book about building trading plans, I spent a full third of that book discussing this issue about trading plans matching the trader. Okay, firms that sell trading systems and trading plans are good at one thing: educating you on running their trading system. Let's call them, for the most part, for argument's sake, let's call them gurus. They don't know you. They don't know your strengths. They don't know if you're patient. They don't know if you're high strung. They don't know your strengths. They don't know your weaknesses, and if their plan really is right for you. For them, if you just follow what they say, and they believe that if you just take a deep breath and do it, you can do it, you'll win. So their notion is one size fits all. But the truth is that every trader is a little bit different. And the trading plan needs to match you. It needs to match you as a specific trader. For instance, I'm not going to call myself ADD, but you can tell just by the first, 20 minutes with me that I'm out there a mile a minute. And I have this sign on my desk that says slow down. So I'll slow down a little bit. A slightly ADD trader, I'm going to call myself that, who lacks patience, should likely be trading a plan that requires waiting for a certain criteria to fall in place. Should not be trading a plan that waits for criteria to fall in place. I'm more fit trading a plan that has frequent signals. So when I build a trading plan, for me, I like the action. I have this concept, and I live by it, that if I'm not in the market, then I'm not going to have a chance. But I just don't willy-nilly get in the market. I need certain parameters, and so I want to make sure that the trading plan that I build meets reasonable technical parameters, but gives me signals so that I'm in the market most of the time. Okay, so I need a trade. So I'm going to have to eliminate the majority of trading plans out, no matter how they tell me it'll work if I just follow it. A trader who's a person who's usually cautious, my accountant, every time I walk in with my tax pile, he says, I'm looking at it, he's trading options. And he's sitting there, laid back, almost asleep. And I'm saying, what are you doing? You can't, he's just cautious, and he's slow moving. And a trader who's cautious would be best served by a trading system that has several confirming hoops and jumps before initial. When he puts on a trade, he figures he's going to be in it for a while. They got wide stops. He uses his position sizing is small. He's learned, and I've helped him a little bit with this, how to negotiate trading to fit him and his personality. Okay, and a trader and there are other issues. A trader whose father is a gambler. There's personal family issues that nobody would ever get into. A trader whose family was a gambler and saw his family finances obliterated may be best served by a trading plan that keeps trading losses to a maximum of 1% per trade, not the industry accepted 2 or 3% or whatever, but 1%, because somebody like this who has a history in their family of horrible things going on financially and trading wise, especially, who lost all their money, or I have a friend whose father lost everything as a gambler. Same kind of thing. You look at trading as a form of gambling. You're saying, hey, I'm afraid that I don't want to be like my father. You just have to be aware of who you are. If you keep your trading risk down to that 1%, if you're this person, you're going to have a much better and easier time following your trading plan and not getting scared and nervous before. And you need to see probably a psychologist about that issue. Okay, but the truth is there's no one-size-fits-all system. Okay, that's my point. And the third reason that we keep on refunding our accounts, no matter how many times we blow them out, is the industry is complicit in what I call the hopping game. Sounds like fun. It's not. We've already established the fact that the vast majority of traders lose. It's true no matter how good the trading system is. 90% of traders lose because there are two necessary components to winning trading: a valid trading plan, which reputable gurus do supply, and the ability of the trader, mentally and emotionally, to follow said plan. Now, Anka talked about how she uses the basics to build a trading plan that makes logical sense and therefore easy to follow. And that is a good basis to come by. And she will be the first to tell you that's not all that you need. You need to be aware and do other things in order to keep, look, the market's consistently attacking you with reports and news, and you have to keep your cool. And the way you keep your cool is to keep your risk within control, have your stops in, all those technical things, but also the mental and emotional capacity to stick with your trading plan, okay? And that is what gurus do not supply. So you need two components. You need a valid trading plan, you need the ability to follow the plan. So gurus are teaching you how to run your trading plan, period. Although responsible firms will give mention of the importance of mental and emotional management to successful trading via articles, videos, recommending books, etc., that's not enough. That'll only get you neurotic, usually. I mean, I've seen traders who come to me right after they wrote a book about trading discipline. They said, I'm scared now that I read the book. It may bring up the wrong things. I mean, you can't read a book and then follow it if you don't have the subconscious pattern that I'm going to explain to you in a second. It's not enough to turn destructive behavior to supportive behavior. It's just not their field. It's not what a guru does. And so the losing continues. But what's worse is that rather than encouraging traders to do the inner work, which to the guru's defense, most traders don't even want to hear about the fact that it's their fault. And it's not really your fault because you don't know. You didn't know the importance. You didn't know the aspect. But generally, if traders who resist doing trading and doing mental work and come to me and say, I don't know why I didn't do this years ago. And I ask them, well, why do you think it is? Well, because I thought that, I thought that in a way that you were kind of, the idea of mental training means that I'm at fault. That's what happens when you dig in. You're not at fault. It's not your fault. But maybe after the third or fourth account rebuilding, it is. But most traders don't want to hear about it. So, the gurus don't want to deal with it. That's not their expertise. They're into the dream and how to trade. And they give you the good stuff because most of their systems will work. Some better than others, but most will make you money if you follow it. When a trader loses, and 90% we've established who lose, they will look for another holy grail because of the bombardment of advertising that I mentioned keeps their dream alive. So gurus know this and understand this, and it leads to cross-promoting. From a marketing standpoint, we all build lists. I have a list, I has a list, everybody has a list. We all, for those who don't buy our systems, many gurus will promote other gurus' system and grab a commission for the referral. It's, everybody's, when I first entered the industry, I was floored when I saw a Forex system seller advertise somebody else's Forex system seller. And it goes under the expression, well, not every system is for everybody. And in kind of a loose way, why don't you try this person's system? Because if you buy it, and I refer you, then I'm going to get a commission for it. And there's nothing wrong with that either. Referrals and commissions, it's part of the whole advertising scheme. There's nothing wrong with it, except it's not serving us as traders. I mean, we're a victim of the system, okay? But the system's not at fault. In the end, we have to understand what the system is. The trader keeps hopping from trading system to trading system, never really gets it, that the missing piece is the self-analysis, self-correction piece. Look inside. He or she continues to be drawn to the next promise of riches, so they just keep buying. So here, I've done several polls. This is really the latest one, and the smallest one, because the polling firm that I used before, I said goodbye to a couple of months ago, and this is the only one I did recently. But really what it says is, how many trading courses have you purchased? And the majority of people who answered this, 70%, and it's true of all the right in this area, 70 to 75% have purchased at least 3 trading systems. It's just, and I get the same with how many accounts have you blown out and refinanced, and this is the same number. So you're running around that treadmill. And if you think about it, a trader who finds his or her way to profitability is making money and content, and they stop buying. So in the end, it serves the industry that you don't win, and you keep hopping from trading system to trading system. You keep buying and buying. So I get angry when I have to keep buying replacement razor blades. I mean, they worked that system, and they worked it on me. Let me be clear. I'm not saying that the gurus don't want you to win. They do. Everybody, we all want you to win, and they all want you to win. I know 100 of them personally, more than that, and I can safely say they do want you to win. But the industry is not set up like that, because the industry de-emphasizes the requirement of the mental and emotional management to succeed. It's the trader who doesn't want to face the truth. So why should the gurus emphasize it? I mean, when I got into the specifics of getting out of, although we do have something called simple trading plans for those that need a trading plan, but my 90% of my emphasis is helping traders with the mental and emotional. I was warned against it. They say, if you're selling something, don't sell something that nobody wants. Sell what they want. Sell the dream. I couldn't stand it anymore. And it's, it's not going to be the biggest firm ever. I mean, we're doing fine, but it's a firm that's an uphill battle with traders. It really is. And yet, I'm trying to show you why it shouldn't be. I'm trying to show you that to get out of the black hole, you've got to do more than just talk about why only 10% of traders win. Okay, only 10% of short-term traders are profitable. And it's not because 10% because only 10% have great trading systems. Only 10%, they do little or nothing to improve their mental focus and emotional control. The fact is that the two statistics are directly related. 10% of traders win, or 90% lose, and 90% do nothing at all about trading. Is that even written right? Only 10% of traders do little to anything at all to improve. Yeah, I guess it is written right. 10% do anything at all, okay? You get my point. If you're not training your mind, if you're not paying special attention to the mental and emotional issues, you're likely going to be in that 90%, unless you're like some freak of nature. Because you have to be. And a freak of nature to me is a 1 in 10 person, okay? The bottom line is the ball is now in your court. If you're ever going to finally be consistently profitable, and it's a short-term trader, you need to include a process of managing your mental and emotional capabilities. My question to you is, what is your primary thought or emotion that has you trade in a way that compromises or hampers your trading? And again, I'm not going to look at the chat here because of our time constraint. Not that I'm not interested in what you have to say, because that's all I'm interested in. In my business, I mean, I'm talking fast right now, but I'm almost silent when I talk to traders, because we need to know about you and the way you think. I did do a poll, and you can see that lack of confidence, patience, fear of losing, hesitation to pull the trigger. These are all about equal areas of concern for traders, that if I ask them what's that one issue that's really holding them back, in the end, when this recent poll was completed, it was hesitation to pull the trigger that won by just a nose, over lack of confidence, and patience and fear of losing was third, and the runner-up, but still Just as important to those people that have that affliction is trouble overcoming losses and greed. So the commonality of these issues can vary with market conditions. In other words, in fast markets, you know, their fear of losing could be an issue. Slow markets, patience can wind up, if you take a poll, be an issue. So these are the ones that over time, so I think probably one jumps out at you, okay? And the top responses in general, when I take a chat, when I have the time, are fear of losing, which causes hesitation, fear of missing out, FOMO, okay, causes entering before a complete confirmation, chasing trades, you know, where you're not sure, and then you wind up buying at a higher price and increasing your original risk, fear of a profit turning to a loss, fear of not being right, where you mix your ego with, you know, you're wrong a couple of times and now all of a sudden you've got your ego involved. Lack of patience to wait for total confirmation. Boy, it's about to cross that one moving average is, I mean, it's going to cross. Why don't I get in a couple minutes early and get that extra? No, and of course it backs down, and you lack patience to wait for the moving averages to cross. Greed, I think we all know what that is in revenge trading. You know, that happens when you do too many of these other things and you try to prove to yourself that if you just do it quickly and without fear, just do it, then it's going to work. Revenge trading is really hurtful, and you wind up saying that I'm not good enough to make it as a trader. That's where you say to you, that's where you know that you've almost hit the bottom. These issues are like onions, and this is what we find when we work with traders. These issues are like onions. Once you rid yourself of the first layer, may be fear of losing. Once you peel that onion back, what happens underneath it is fear of missing out. They're all kind of entangled, but the one that you picked out in that last list is the dominant one. Once you take that out, you can then expose some of the underlying issues that you can also, with some of the quick process that we have to eliminate and neutralize these feelings, can just go after them one at a time. So these are layers upon layers, and this is the way the mind works, okay? I wanted to give you an offer, and it's a free offer. It's actually started already, but it's not deep enough into it. It's a 5-day pull the trigger without hesitation challenge, okay? It's free. Okay, and I mentioned to you in our last poll that we did, I said, which one should we do first on the challenge? Which challenge should we make? Because I wanted to do a challenge, because I wanted to challenge our traders that entered this to take the mental trainings that we offer. Just do them. Let's all do them together. Let's not try to do it by ourselves. Do it yourself. Let's all do it together. Let me challenge you. And so pull the trigger without hesitation, one by a hair. So I made it. And pulling the trigger without hesitation comes in many forms. One form is not being able to initiate a trade. Another form is moving a stop around, not putting your stop in, or lifting a stop, not following your trading plan because of not putting your limit in to take a profit because you think this report could be the big thing. Whatever it is, not pulling the trigger on whatever your trading plan is telling you to do, okay? Pulling the trigger without hesitation was number one. So this is the challenge, okay? And I want to show you quickly how the brain works, just because I only have a few minutes left. What you're seeing is an actual micro photograph. This is a photograph of the brain in action, of your subconscious mind in action. These tendrils, these thin wormy things around here, these are literally energy. They're neural pathways. They're pathways, physical pathways carrying energy. I mean, energy is, I'm not going to go through it. Energy is a thing. It's not just, out there some strange vibration. It's quantifiable. Okay. And a thought energy is the same thing. When you have a thought, it generates one of these neural pathways. Okay, and oh my God, I just lost on that trade. I better be a little bit careful, but let's see what happens. Then you lose another trade, another neural pathway. You have the thought, oh my gosh, that's 2 in a row. And when you have the same similar thoughts, it will it will build a neural net that becomes your dominant response to a stimulus. You see, these neural pathways have the same thought energy. Okay, and when it builds into one, if there's enough of them, it builds a neural net, so that when a trade comes up to take, you're going to hesitate, because it's not your conscious mind. Your conscious mind is not what you're looking at here. Your conscious mind is saying, I better take this trade. You know, I really should follow my system. But somehow your hand is still on your coffee. You're not taking the trade, and it's because decisions are made by your subconscious mind. Your conscious mind feeds your subconscious mind, but whatever you feed your subconscious mind it accepts as true. So if you take a few deep breaths, if you meditate, a meditator knows that if you take a few deep breaths and drop down into a very simple alpha theta brainwave state, and you listen to suggestions. I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. I understand that taking a trade immediately after my trading plan tells me to take it is going to lead me to success in the long run. I understand that losing trades are part of the long-term trading success. If you put those kinds of thoughts, you make these neural pathways. When you're in an alpha brainwave state, you go around your conscious mind, and these thought tendrils, these neural pathways are built directly to your subconscious mind without any editing by your conscious mind, and you can quickly build a neural net that serves you as a trader. It has to be a bigger and more robust neural net than the one that's causing you ill for that stimulus. So it's up to you to train your mind, and that's what we're doing. We're all doing it together in 5 days of this challenge. And I wanted to. Here's your commitment. If you accept my challenge, it's free, remember. But and you know, I was talked out of it because I am a kind of guy that says, you know, if it's free, are they really going to take it seriously? And there's a lot of people that won't. But I think if you've taken anything that I've said seriously here, you're going to take this seriously. And I'm okay with the free. I was talking to them, and I'm okay with it. But do not think that because it's free, it doesn't have value. This has more value than probably anything you've done for yourself as a trader. Okay, ever. I don't care what courses you've had, you know, because if you've never paid attention to the mental and emotional, this 5 days, by Saturday of this week, you will have turned around your resistance, your hesitation to pull the trigger, to confidence to pull the trigger. And if you just take 12 to 18 minutes a day, that's all I'm asking you to do for 5 days. But it's going to be a little bit more from you, because this is the second day, so you're a day and a half behind. Okay, my promise to you, by the end of the challenge, is you'll be confidently pulling the trigger on trades. Here's what, and in those 12 to 18 minutes, you're going to be watching. I'm not asking you to run on a treadmill. I'm asking you to watch a 5 to 9 minute video where I talk much more slowly. Okay, a 5 to 9 minute video where I show you some information that's important, and then you do an assignment. And that assignment primarily is doing a very short 5 to 9 minute meditation. I'm not even asking you to sit in a lotus position and climb a mountain and sit there for 2 days. I'm asking you to sit in your chair, take a few deep breaths, and listen to my wife Tisha, who's our subconscious trainer, and just listen to what she has to say for 5 to 9 minutes. Or actually, one is 11 minutes. I'm a wise and disciplined trader. I do the things that a wise and disciplined trader does. I understand that a losing trade just brings me closer to winning in the long run. We've constructed these suggestions. We know what builds those neural nets quickly, okay? And we've put them all in. And in this one training, I'm giving you a big promise, but I'm saying to you that if you experience this, that's going to energize you to do more. And we can sell you that, and it's not expensive, because I know that there's always going to be resistance. Okay, so. But I want you to experience the change yourself, okay? And all I'm asking you to do is watch a 9 minute video, do a 9 minute assignment, which is pretty much a meditation, and leaving a comment and telling me how you liked it, what you thought, so on and so forth. Okay, here's what the page looks like. I'm not even asking you to hop around. I'm asking you, here is, you notice here, coming soon, coming soon, coming soon. These are the next 5 days. This one's going to be available tomorrow on Wednesday, Thursday, Friday, but these two are all already available. Start on one, click this, and watch this. This is 2 I have up here. This is the second day. I click this, and here's the second day, and here's what, and this is a 7-minute video that you'll, 7 minutes and 55 seconds, and right here there's a meditation that you'll take. Okay, so this is day 2. Day 1 looks pretty much the same. Day 3 is different, 4 is different, and so on, but this is what you'll see. So if you take this, if you use this link that I'm about to give you, and you take advantage of it, this is where you'll go, okay? And here it is, thedisciplinedtrader.com/pull trigger. Sherry, if you would put it in the, I know you're probably doing it now. This is, you always beat me to the punch on this. Thedisciplinedtrader.com pull trigger.
Got it ready to go.
Excellent. Let us help you. Hey, it's free. And I think I've shown you, and I've tried to prove to you that it's up to you, and that we're on a treadmill. We're in a black hole. The industry, it's not that it doesn't care. It does want us to win, but it's not set up necessarily to make us win, because it de-emphasizes what the half of what you need, and that is the mental and emotional control. So I invite you to come to the free 5-day pull the trigger without hesitation challenge. I think you're really, really going to enjoy it. And that is it for me.
Wow, that was right on the money. You
Woo!
did go fast. Woo! All right, folks, that is something that you're going to want to take a look at. It is going to be incredibly helpful for your mindset, right?
That's
and
correct.
being able to get to where you need to be for your own style of doing things. Norman, as usually, thank you so much for being with us. I appreciate it so much.
Well, thanks for having me, Sherry. I've always, you know, and I will say that, you know, I don't do a lot of these, but I like yours because you have quality people, and so I appreciate being invited.
Awesome. Well, you're one of the quality people, that's for sure. So we appreciate it, and we look forward to having you back again in later in the year.
Thank you.
We're almost done with the year already. My goodness. Okay. All right. Well, you have a great day. I appreciate that. Yeah, we're right on schedule for the next speaker. So I will just tell everyone to get in touch with you, accept that challenge, and look for email from Norman.
Thank you.
All right. Have a good day. All right, folks, here we go. I want to show you that was Norman Hallett of the Disciplined Trader, and he's going to be helping with your psychology and getting through and setting up what needs to be done and how it can be done better, and how you can get in with the 10% and get out of the 90%. So our next guest coming up is Paul Bratby of Global Trading Software. And he's going to be talking to us about volume, price action, and behavior. And just remember, if you have to leave early, you automatically get the replay link in your email later. And in the future, you can listen to this webinar at tradersexclusive.com/archived_webinars. And usually we get that up by the next day, but you still can get the GoToWebinar replay. Now, Paul has served 15 years in the British Army, and since leaving the Army, he has over 17 years in the financial markets. He retired as a money manager at age 45, and since then, he's dedicated time to reproduce his successful, simple, and repeatable strategies into trading indicators on multiple trading and broker platforms as the CEO of globaltradingsoftware.com. Thank you so much for being with us, Paul. Let's see if you can unmute yourself.
Yeah, I'm here. Thank you, Sherry.
Ah, welcome, welcome. Thank you so much. So I'm going to turn you into the presenter, and I'll also make it so you can see the chats.
Cool. Excellent.
There we go.
Okay.
All right. So take it away.
Okay, so let's get started. So again, thanks, Norman. I actually, listening to Norman, I'm a freak. because I have no emotion. So when I'm trading, there's no emotion for me. It comes from all the military service and the years of trading, really, and obviously emotion is a killer.
That's a great skill. Yeah.
So I'm a freak. So again, and it's all that goes down to behavior and understanding behavior as well. So even if it's the behavior of your children, your dog, your cat, the markets still have behavior, because guess what? Human beings trade them. Plus also those human beings also program those algos that trade them as well. So there is behavior there. We just need to figure out where it is and what it looks like, and to understand that behavior to help us trade, not just to actually get in, because anybody can get in a trade, also to manage those trades as well. Now, hopefully there's some of the guys, some of our users on here as well. So in the chat, just give us a shout out if some of the users are our Discord groups in there or anything like that. Just give us a shout out on the chat so I can see you're here, and then we'll get going. So volume, price action, behavior. I'm going to cover it in 3 separate things. We're going to talk about volume first, then we'll talk about price action, and then we're going to combine them to look at behavior. So let's get going. Right, so volume first. A lot of people really don't take much notice of this, but it's very, very important. So let's talk about volume in a simplistic way. So the simplistic view of volume is like throwing pebbles at a glass window. So throw one small pebble and you probably won't smash the window unless you're The Rock or something like that. But lots of different sized pebbles and the window is likely to smash. So one little pebble, 100 shares. It could be 100 contracts or one contract. Against 100 shares, 50 shares, 350, 50, 50, you know, lots more volume coming in, bigger rocks, not just little pebbles. And eventually, you know, we have to break, because there's nobody willing to sell at that price anymore. So we have to go higher. The broker has to put the price up a little bit, because there's no more sellers. No more sellers interested in selling their shares at a specific price. More and more people are coming in. So what the broker has to do is put the price up so people want to sell it again, because there's only a finite amount of contracts or shares or you know, crypto and everything like that. So there is a time in which nobody else wants to sell or nobody else wants to buy, and the broker has to move it, and that is controlled by volume and what people want. They need to entice the sellers. So not enough sellers. So understanding volume. So that's simplistic view. Now we're going to look at volume accumulation candles and volume distribution candles. These are very important, and we're going to go through them one at a time. So an accumulation candle is when people amass or accumulate more shares at the ask. So they're putting in buy orders. So rather than putting in bid orders, which are sell orders. Okay. So this is a sub chart of a volume chart, if you like. And we can see here on this particular candle, there's that amount of volume. Okay, the next candle has more volume. So this is called an accumulation candle. So there are more buyers than sellers, basically. Okay. And again, going back to that pebble, I think we're getting more buyers than sellers. They have to put the price up. There's more volume coming in. And again, more. So we're accumulating every single candle. And that candle could be a 1 minute, a 5 minute, a 15 minute, a daily. It doesn't really matter. It's that time in which is traded. If there's more traded in the next candle, we're accumulating more of a futures contract or a share or something like that. So if the stock has two or more accumulation days, then we can say it's looking pretty strong or bullish. You know, we don't look for those one-hit wonders. just one accumulation day or one accumulation candle. 2 or more, we're looking at that it's looking pretty bullish, like in this instance here. So one thing to also note, in an uptrend, volume increases in a steady way, in a trending wave. Okay, now you do get some really parabolic moves, then unusual, and they're very hard to predict. But usually when we're going up, it's steady and it's trending. Okay, next is volume distribution. Okay, so a volume distribution day or a candle. So we're dispersing shares or futures contracts. We're really selling our shares in a sense. So in the first major point to note about distribution candles or days is that we're related to the selling of shares, not buying. There's it's wanting people to offload or selling. So most important piece of the puzzle when looking at distribution candles, for a candle to be considered distribution candle, the stock not only has to end down overall, but there also has to be more volume traded than the day before. Okay, now in this case, we can see the first candle, it could be a day, it has this amount of volume. Look at the next day, it's almost twice as much. So we're distributing, we're dispersing, we're selling, everybody just wants to get out. Then the next day, we get a little bit of a relax, but then the momentum starts to build again. Okay, so again, just like buying, if a stock has 2 or more distribution days, then we can say it's looking pretty weak or bearish. Remember, for the second distribution day, it has to have more volume than the previous day or candle. So for a distribution day to be considered heavy, the volume not only needs to be greater than the day prior, but it also, you usually see that it's greater than the average daily volume. I'm not going to talk too much about average daily volume today, purely because I think we just need to keep it simple for this session. But in essence, what we're looking for is that the volume increase is more acute compared to accumulation days. One of the things to take away is things drop down a lot faster. There's more gravity. Gravity is present in the markets. So you'll see trending when it's going up is steady increases, those accumulation days, but selling is different. Those distribution days, the volume increase is a lot more acute. So let's go on to price action. So we just covered that volume. We're going to come back to it and we're going to put it to price action later. So we're going to look at collective price action. Got to do it reasonably quickly because we're short on time. We're going to look at support and resistance zones, highs, lows, pivots and trends. Okay. We're then going to look at specific price action. So candlestick patterns, wide range rejections and contraction, that sort of thing. And don't forget, you'll be able to watch the recording of this if you don't get it all the first time. So let's look at support and resistance zones. Now, a lot of people that subscribe to our YouTube channel and everything, one of the biggest things for me is looking left and always framing that chart with support and resistance zones. And now it's a little bit subjective where people would put it, but I do a lot of training on this in our videos to help traders to understand where that major sort of rejection points are, where that support and resistance are. So remember, as retail traders, we really don't make too many decisions that make the market move. Okay, it's institutional traders that make decisions at similar price points. When these match, we can draw lines of linear support and resistance. Okay, so we're looking for the line of best fit that includes highs, lows, and wicks. So in this case here, we see there's 3 wicks into here, and we see the bodies of these wicks there. So that really forms a great sort of top end of a support and resistance zone there, because that really is a sensible price to draw that zone. But then as time goes on, we see those bodies also at a similar sort of level here, but also we get a big rejection wick at this bottom. That helps us form and move that into the future, into the right, our support and resistance zone for around that price. Remember, there's no support, there's no such thing. If anybody tries to teach you support resistance level, it's absolute bullcrap. There is a zone of price. There's always slippage in markets. There's slippage in people's brains. There's slippage in institutional traders' brains. When it gets to a certain point, they look left, oh God, got to buy here or got to sell here. And there's always a little bit of slippage in that. That's why we put support and resistance zones in there. And then again, look how that tests. Now we move through, we come back to test this support and resistance zone from below, and really does help, okay? Again, here, we fall down through this one, we get a good rejection, comes all the way back up. We test that again, but eventually it breaks through, okay? It really breaks through. So one of the main things to take away from this is understanding where those pivots are and joining them together. Remember, those pivots are really, they're dictated to by institutional traders or algos, really. We don't do, you know, we can't affect those markets as retail traders. So what we've got to do is understand that behavior and where those support and resistance zones are, where these are decision zones, if you like. Decisions could be made again, either from above or below. So we need to be aware of that. We don't want to short into support, for example. We don't want to go long into resistance. So the next one, highs, lows, pivots, and trends. Do you see price barely making new higher highs or lower lows? Highs, lows forming strong chart patterns. Long trend channels with small pullbacks only. Larger candle wicks whilst price making new highs and lows. Short-term reversal, swing pivot points. All these things sound really complicated, but again, I'm trying to make it simple, and then what we'll do is we'll try and find some instances on real charts in a little time. But again, you can watch the recording of this. So let's look, price barely making new higher highs or higher lows. So imagine a roller coaster. When you're going up, you just run out of juice. You get to the top and it comes back down again. And this is what this is like here. So, and a lot of people that have sort of traded with me in my inner circle, or when I've done sort of training webinars and stuff, I always say signs of exhaustion. And this is exactly what I'm talking about here. So we're getting those higher highs, higher lows. We get a little pullback here, not too much. Okay, that's a potential warning sign, okay? Get an inside candle there, potential warning sign, but I call it a one candle wonder because then it goes again. And then we get another little warning sign here. We're inside this, this body, this wick body here with these two candles. So there's more warning signs coming. We're running out of juice here. Then we're getting slightly higher highs, higher lows. So we're crowning onto the top of there. And understanding that price action is very, very important. This is momentum. This is unsophisticated, what I call traders by just taking their profit off. Or it could even be you know, taking, you've got institutional traders taking small parts of their position off, but not enough to start the stampede to go down the other side. Then we pick up again. But this really, these slightly higher highs, high lows is a really good sign that we're getting to the peak. And it's the same for going down as well. Remember, we said it goes down fast, it does. But then we get those slightly lower lows, okay? So we can see it's running to the bottom and the roller coaster is going to go back up again, if that makes sense. Okay, so this is what we're looking at with those price barely making new highs, higher highs or lower lows, and that's running out of juice. So highs and lows forming strong chart patterns. We're not going to go through them all. We're just going to do some very basic ones as well, because it's important to understand. So what we have here is at this point, remember, we can't look right. When we look at this, we can see a big sort of head here. We got a left shoulder, we got a right shoulder. Usually, when we're looking for that short, we're looking for the right shoulder to be slightly higher than the left shoulder. Okay, this is what we're looking for. So this is a good short, and the short is usually below the neck here, if you like. This pivot point here is when we would look for that short. Now, obviously, we're going to look at other instances there, but this is what you would call a pretty standard head and shoulders. When you look left and you see this bit of resistance zone here, it pulls back down and then we shoot back up, but then it rejects and comes back down again. Then we have another go at going up, but again it finds resistance slightly higher, but then it gives up the ghost and comes back down again. That's the behavior, and then we'd look to trade that small that short through there. Okay, so highs, lows forming strong chart patterns, head and shoulders low this time. So again, this time we're looking for support. So we have a move down, we find support. It doesn't really hold for long, it comes back down. We form the head, moves back up again, doesn't like it, comes back down again. We get, usually this time, this shoulder is lower than the left shoulder, and then it pushes up. Where do we go long? On this pivot here, okay? This pivot here. Because this is where it's recently failed and it's come back down. We've got this support, which is actually higher than the head of the head and shoulders. So there are some bullish signs here. We go through this pivot, and that's the long. Highs, lows forming strong chart patterns, double top high. Okay, so now there's a lot of conjecture out there, but this is the basic rules, and this is the basic rules that institutional traders use, because I was one, only for a few years. I wasn't greedy, made money, retired. So price for tops and bottoms has to be within 3% of the price approximately. Okay, it's, when we're doing that line of best fit, that those support and resistance zones, that's what we're looking for. It's that line as best fit, and if it's within 3% approximately, then we've got a double top or a double bottom. Okay, so with a double top here, we have a fantastic move down. We've probably got an earnings reaction here that we get a move down, we get a gap down here, we come back up to test it again, we form this zone. We can say that's a double top high there. This is a support zone with these two C pivots. We'd go short going down below there, and that's the short. And you can see that's the start of a trend coming down. So again, it's just about understanding and spotting those. It's a lot easier sometimes if you frame your charts. I frame my charts every day. If I wake up on the European morning, because I live in Europe, I will look at the overnight highs and lows if I'm trading futures on gold in particular, and I will frame my chart. And sometimes you'll see those double tops and double bottoms. They're very, they happen a lot. So highs, lows forming strong chart patterns, double bottom lows this time. Okay, you don't really see it, but you do. This is actually really a triple bottom. Okay, we're within 3% of these rejections. Comes down. Okay, here fails, down here fails, down here fails. Where do we go long? Through this pivot here, we get this big momentum move, and you'll see usually the volume really start to pick up there, and these will be accumulation days as we're moving up. Next one, long trend channels with small pullbacks only. So when you look at, before COVID obviously, but when you look at stocks like Visa or even the S&P 500 on a daily time frame, very narrow long bullish channel. And people say, well, how do I get into those? You need to look on smaller time frames. Within that channel, there are trading opportunities, even if you've not got a sophisticated indicator suite like Elliott Wave or my own expert algo, or harmonic patterns or anything like that. If you're not anything like that, there are signs on smaller time frames within that channel. You're pretty strong, and it's a strong channel. You're pretty sure that when it's moving in that channel, you're only looking for bullish trades, by the way. If it's a bullish channel, you're not looking for shorts. So then we go down a time frame within that channel. So this is now on the 60-minute time frame within that. That first channel was drawn on the daily. But what we see are double bottoms. This A and C pivot here within 3%, double bottom, goes through the B pivot, go long to the center line of that channel. Again, another double bottom right here, okay? And that's almost to the cent, okay? Again, we've got fresh air up to that center line. Do we go aggressive? Do we go, you know, through this B pivot? That's your trade plan, if you like. You know whether you're an aggressive. I mean, obviously there are tools out there to understand that behavior with the volume and everything like that, and I'm going to show you that in a little while. But if that volume really starts to pick up and it's higher than average volume, you've got those accumulation days, maybe you should get in there more aggressively. Okay, short-term reversals and swing pivots. Now, I'm not going to dwell on this too much, but I've been trading Elliott wave for a long time. And we look for those wave 4 pullbacks as profit taken against the main trend, and then look to trade that fifth wave. But this clustering around that pivot is not a good sign, okay? And then when we do finally pull back, we get clustering around this pivot. It's not pretty. You wouldn't take it home to go and see your mum, okay? It's not pretty. It's bad. We just don't trade those type of things, okay? So when we're looking at these short-term reversal swing pivot points, is that we've got a main trend, it pulls back against the main trend. We need a clean pivot, not something that's clustering around both pivots. This is an example, okay? So you can see here, we have the wave 3, rejects, comes back down, higher support. Then we're getting these, look at this. These will have accumulation days on them. These will really get some, you see how it just comes back a little bit, and then we get slightly higher highs, higher lows, going back to that subject that we talked about earlier. Slightly higher highs, higher lows, puts the top of the roller coaster, and then boom, straight back down again. So these are better pivots. These are good pivots to trade, and understanding these barely higher highs, it's running out of juice, and you'll see the volume start to run out of juice, and then you'll see on this candle volume probably start to increase, and then it goes, okay? So that's that behavior. It's good behavior. So now the next thing is candlestick patterns. We're going to stick to the core patterns that will help trading the fifth wave, or look at those pivots in particular. And you'll see these pivots at double tops, double bottoms, that sort of thing as well. Can't go through them all because that would take a whole day. So the candlestick patterns. The first thing we're going to look at is a hammer. What we're going to do is we're going to look at these candlestick patterns on their own, and then we're going to look at them with volume. Okay. So hammer or a shooting star, you know, in this case, really long wick here, really, really long. It's rejected those lows like you wouldn't believe. It's gapped down, it's gone down, and actually nobody's interested. All the buyers start to come in and pushes that ball up. That's a massive rejection of the lows, if you like. And they're very common on those pivots on that Elliott wave pullback, or any pullback against the main trend. And usually you'll find a lot of them on double tops, double bottoms, that sort of thing, because it's just a massive rejection. So it's a rejected price level. Now, piercing line. Okay, it's not as strong as a hammer, but what you've got to think of when you look at these candles here, we've got a big red candle. It closes right near the low. Then it gaps down because this is the open of the candle here. And the market says, no way, I want to buy here. This is a great price. This is great value. Start buying. And it comes up and it's nearly a full body again. It closes near the high. This is why it's called a piercing line. Both bodies have the piercing line on there, and they're pretty full candles, okay? And then we start to move away from there. Excuse me, it's been a long day. We're talking 9 p.m. here. Okay, so the next is a bullish engulfing. So in this case, we've got down candles. We gap down on this candle, But then, do you know what? So many buyers come in, that candle actually engulfs that whole one and just goes hell for leather. That's called a bullish engulfing. And bearish engulfing is the opposite way. We're moving up, we're getting to the top of that roller coaster, if you like, and then all of a sudden we gap up, nobody's interested. All the sellers start to come in, and this will be a big distribution candle here, which engulfs that little one before. Trying to rush here because I've got to get to charts as well. Been going half an hour already. So these identify reversals in effect. Bullish harami, pregnant lady, whatever you want to call it. We got the big down candle, closes near the low, gaps up the next candle, keeps the main, closes pretty good, and we've got this full body candle within here, looks like a pregnant lady. And then morning star, it's on its own basically. Got to rush through, but basically it's a morning star. So we gap down from this first candle, and then we get this indecision doji. So no, buyers and sellers are about the same. Nobody really can decide. But then the next candle gaps up, so it's left all on its own. Like, again, they identify reversals. You can watch this back and replay it. So this is where the volume comes in here. So this happens more often than not. So here we have a rejection. So we have a hammer, but also forms a bullish harami. Look at the volume on that rejection. That's an accumulation candle. More importantly, usually the following candle has a higher high, higher low, but lower volume. It's not as powerful as that rejection on high volume. Then we start to get higher highs, higher lows, and you start to see now this last candle here, accumulation candle. So we start to build that momentum up again. So it's that massive rejection, bit of a rest, then we start to get the higher volume as we get those higher highs, higher lows. So the next is a piercing line. And again, we're talking about volume on this one. So we're moving down. We've already talked about piercing line. Now, in this case, we see these distribution candles here. So we're increasing volume on the downside. It's almost like a piercing line is almost like putting the brakes on, if you like. So it slows down a little. It's a bit slower than a big rejection like that hammer. So you'll usually find the volume's a bit lower on this one. But then the following candle, 99% of the time, if we're going to go long, is higher volume, higher high, higher low, and higher volume. Bullish engulfing now. Again, we can see these distribution candles, the volume increasing each time. Look at this candle. So we gap down, hell no. All the market says no, I'm buying, but they buy with volume. That's a massive rejection. And 9 times out of 10, the next candle is higher high, higher low, but lower volume. That's normal behavior. And then next candle is another bullish harami. This time we get a really strong, big red candle. We gap up, but it's usually lower volume. And then we get a little bit of a rest period, and then you can see slight accumulation day there, and the momentum starts to build again. So behavior combines what we've just discussed. So you will see that volume and that price action at pivot points, at when we get those slightly higher highs, higher lows, double tops, double bottoms, that sort of thing. Okay, so now we're going to go to the charts. If I can escape from here. Okay. So we have around about 13 minutes left. So what I've chosen is futures contract, crude oil. One of the things I want to talk about first is the double tops, double bottoms. So this is the hourly time frame. Again, it should be framing your charts when you come in into the trading day. And you can see here at this point and this afternoon, this was really, really good double top here. We got the top of this wick and we joined in here. And if we look left, this is, and then we've got another short-term double top here. So we're, at this point, if we're coming in, this is 1700 European time, and again, this is 1500. This is just before the open of the US stock market at this point. Go down the time frames, then we look at this double top here, we can see how that moves. This is the 15-minute. If we're day traders, we're looking on the 5-minute. So what I'm going to do, because this is pretty cool on TradingView, is you can just highlight that bit there, and it highlights on all the charts. So this is this double top on the hourly, okay? This is the European morning, okay? It's forming a double top from the overnight highs and yesterday's highs. This is the 15-minute time frame. Now we're looking to day trade. Look at the 5-minute time frame. Look at that candle here. That is a bearish engulfing with increased volume. How do I know it's increased volume? Because I'm using the volume behavior indicator. The volume behavior indicator looks at accumulation candles, distribution candles, and also up and down candles with lower volume. Now, we are going to give you the link to this in a little while. I said 13 minutes, sorry. So we are going to give this away for free today. And to be honest, I never give anything away for free. And I really do these. I haven't done one of these in 2 years because I am semi-retired. But someone's convinced me to come on. So I want to give something away. So what will happen is, Sherry will give you a link in a little while. But what we do is we produce this indicator on our website for Motive Wave, MT4, NinjaTrader, TradingView, TradeStation 10, and Thinkorswim. And what it does is colors the candles for behavior. So when I see that bearish engulfing, and it's a distribution candle because it has more volume than the previous candle, okay, this is a sign that we could be going short here. And look at the nice move that happened there. Absolutely perfect. Now, there are lots of other indicators that would give you that sign, but this is probably just a backup to say, I'm looking for a short here. It's just hit that resistance zone. I've got a bearish engulfing. It's a distribution candle. I can remember what Uncle Bull said here. This is a good sign that we are reversing here and we're coming back down again after that double top. And it just helps you identify those. Okay, so that's on oil. Okay, now in the chat, can anybody in the chat, I've not seen it. Right, does anybody want me to look at a specific instrument? It could be a crypto, could be a stock, could be futures, could be Forex. Just shout out some tickers and we'll go and have a look at that volume behavior on there. In the meantime, I'm going to go.
You got one, CSCO.
Cisco.
And it looks like we got a couple others. NQ, please.
Okay, so Cisco on the daily. Wow. Okay, I'm telling you now, guys. This was my expert algo 6-star buy, and I'm still in it. That's why that's short. That's why all that stuff's on the chart here. You can see this. You've just pulled Cisco out your hat. You can see how I've drawn my channels on there. Because I don't just talk about it, I do it. You see where my linear support and resistance zones are. Okay, someone's just pulled that out of the hat. So again, this is the daily time frame here on the stocks, and we can see that we do, if I just zoom in a little bit here, something that we do that I'm not going to really harp on about today is something called the manager. So we do have these accumulation candles. See how these big candles here, but when we talk about average volume, these little cyan dots are higher than average volume. But then when we pull back, even though we're getting distribution days, we're getting lower than average volume. It's running out of juice. Gets to the bottom, what happens? We get higher than average volume, we get accumulation candles, and there it goes again. It pulls back, lower than average volume, slightly lower lows, slightly lower highs. There it goes again, there it goes again. And the manager, because I'm on the green bias cloud, is keeping me in. So again, that was a great example, guys. This is me trading. It's on my chart.
That's
so
awesome.
we want to look at NQ next, then. Yes.
Yes.
Oh, I wanted to touch on NQ today actually, because this was a red hot trade. So I want to go on the 5-minute initially on NQ. So NQ today has been a phenomenal short trade. Okay, I just want to go through a couple of things, and I've just done this on a webinar for our users. We saw a harmonic back pattern complete through the night here through the Asian session. It completed the ABCD perfect, and then we had the short coming down into London session, and boy did it hit that support and go back up again. Then we get the New York Stock Exchange open that actually had a go at coming down here. We need to be on Heikinashi. Okay, so then you see how if we come down on the open, we come to test, we come back up again, but then we have these distribution dates. And this, remember, jobs today was today at 4 o'clock. That tried to push us up here, failed, slightly higher highs, higher lows, starts to come down, distribution candle, and you've got to look left and you've got to think, if it breaks this support, I've got to go short, because the behavior, the volume and the price action is telling me I'm going to break this double bottom here and I'm going to go, and it did. So NQ, fantastic example for today. And I know, guys, in our Discord group, we had people trade that today with our expert algos. So it is a great trade, but it's also about framing those charts. What happened yesterday? Where was the low? Where was the low overnight or the European morning? It formed a double bottom. We got data coming out. It pushes up, it fails. Distribution candles pushing us through. That volume is increasing. There's more and more sellers. Boom, straight down. Am I allowed to put the Discord group in the chat, the invite, because it's free? It's not a selling thing. It's purely just for people.
Absolutely. Absolutely.
Yeah. Yep. I'll put that in the chat there.
Yeah, you just got to make sure you choose for it to go to everyone.
Oh,
this is all
okay.
Entire audience.
Okay.
I also had a couple other ones. I just assigned them to you. Someone looking for USD/MXN, and then the GBP/USD. So those are currencies, right?
Yeah, let's go currencies now. Okay, currencies. Well, I haven't got USD Mexicans. I don't trade that. So Forex. There we go. Let's have a look at this baby. Right. So the first thing I want to do is I want to go on the hourly time frame.
There you go, Winston.
I want to scudge it out a little bit, and I want to see if we've got some major support and resistance zones. Okay, so we go here. Okay, so we've got major support and resistance there. That's where we're looking for. Oh, look at this one as well, this support here. This is really cool. This is a fantastic double bottom here with those. So we'd be looking to frame our chart here. If we're going to do some sort of shorter term, do we get any convergence with this? We do get massive convergence with support here with these pivots from that double top. Look at this. Okay, so this is a really strong zone as well. You know, this is now the chart framed. We've got some shorter term, but I want to go to the 15-minute time frame here. Let's just scooch out a little bit, see where we are right now. Okay. Ooh, let's have a look at this. Yeah. Okay. So really what we've done is identified a really good range to trade into. It tips that bottom here and starts to come back up again. It's obviously going sideways now. It's quite quiet. Forex markets are very quiet this time because Europe's closed. But that's what you would look like, what you would look for. You'd start on the hourly, put your support and resistance zones in. You could even go to 4 hourly and see if, oh, look at that. You see, look at this. This is fantastic looking setup here with that double top. You trade the double bottom coming through this pivot all the way down to form this double bottom here. And that's pure price action behavioral trading right there, right there. So the other was GBP US dollar. I think
Yes.
Okay.
GBP US dollar, and then what is it ETH USD? Is that
That's
a
Ethereum.
currency?
Ethereum.
Okay. Okay.
It's crypto, yeah. GBP US dollar. Oh, I'm going to go 4 hour here a second.
Gold and silver also.
Oh my Lord, I'm going to run out of time.
And yeah, you've got about 4 or 5 minutes left because we were a little bit over your start time.
Okay.
And Long says, thank you for your valuable presentation.
You're very welcome. I should do more, but I live in the south of Spain near the beach. So.
And it is about 10 o'clock there almost, right?
Yeah, it's quite late. Yeah.
We appreciate
Okay,
you coming on with us, I know.
That's no problem at all. See, again, I'm looking at channel here. I saw that on the daily. It's broken out of that channel now. We're looking to go, we're looking for shorts because it's broken out of the channel. And look at the candles that broke out the channel. Distribution candle. Look at the volume on the bottom. You don't need that anymore if you use this. Get rid of it. And distribution candle that breaks the channel. Loads of volume breaking that channel, okay? And even when we look at this hourly going it through the channel, comes up to test the center line of the channel, slightly higher highs, higher lows, we get bearish engulfing, distribution candle, rejects the highs, comes down, breaks it, now we're coming down. So that's GBP US dollar. Let's go to Ethereum. This was a trade today. I know some of our users traded this short on Ethereum today. So this is the 5 minutes. So what we have here during the European morning, we have a double bottom form. Okay, then we extend that outright to basically give us a support and resistance zone. And then we get a 6-star sell. So this is my expert algo, 6-star sell right here. Then we get confirmation from the divergence cloud with this red triangle. We get another confirmation here, but we can't go short until we are below. That line's already there, guys, because I've already done this. That's the short there. You see how with this volume behavior, we get a high volume rejection there, but then we start to get big distribution candles, and that just drops like a rock. So that's how Ethereum looks there. You see all of this here. This is all small candles, green, gray, red. Gray is an up candle with lower volume. Cyan is a down candle with lower in volume. But then you start to see this momentum really start to build up. A lot more reds, okay? And then we start to get some bigger candles, and then it breaks through and goes for it, alpha leather. And there was one more on gold, I believe. So let's go to here, gold. Okay.
Gold and silver, and Stephen is asking for BA. And I think that will be all we do have time for.
Yeah. I've still got to share the link for this free indicator as well. So
yeah, I've got it sitting here ready to go. I got it there. You want me to put it up?
Yeah, you can put it up. I'll just show the page quickly again. So what it is it's one of our cheaper indicators. It's $59, but it's still
Sorry, I think I put the wrong thing up there. Just a second.
Okay. So what this does is just gives you name, your email address, select your platform. So it's TradingView, Thinkorswim, NinjaTrader, MT4, MotiveWave, or TradeStation. We have that indicator for you that gives you that volume behavior. Fill that in, and then in the next 48 hours, you'll be sent an email with that free indicator for life. Okay. So gold, again, gold is very good with using harmonics, okay? And you can see here, I want to just pick out this pattern, this Gartley finishes here. This is what we were talking about with a bullish harami, but it's a massive rejection as well. It's a green candle, so with this volume behavior candle, it's actually got more volume than that previous candle. Then we get another accumulation candle. Then we get another one. Then it's gray, so it's slight rest. Then we get another one and another one. You can see that volume pick it up. And we can see with that price action then, when we get to the top of this point, we go gray, then we get an inside candle, then we get a distribution candle. You should be out. This is telling you that this is starting to run back down again by looking at that price action and the volume that it colors on there. So that's gold. Silver, let's go SI. I love silver, $25 a tick. You can make your day or you can break your day really quickly. So with silver, again, it's very, very simple. This we get, I just want to go out a little bit on the 15 minutes, no, 12. That's a lie. Top tip, guys, 12 minutes, fantastic for silver, by the way. Okay, so what we've formed in silver and what happens a lot during the Asian session and the European session is we get a range. Okay, so this is slightly different. You can put the tops on there and the bottoms on there, so let's do that very quickly, like that and like that. So that's the range. Okay, that's framing our chart. Look at the volume start to pick up here when it breaks down. Okay, we get a distribution, basically the whole of that range. Then we get another candle here. For me, the entry is below the candle that breaks. So that closes, look for the next one, and then it just goes hell for leather. Look at these distribution candles all the way down. Now, this is where the manager comes in that we've got. This is my trading brain. I look at that lower than average volume pulling back up into this red cloud, which is telling me I'm still bearish bias. I am not going to panic and take out my whatever it is, $3,000 profit here. This is pulling back with lower than average volume, these blue dots underneath. Okay, we're looking for this to rip back down again, but we're going into a very quiet session, so it could go sideways. Okay, so that's everything today, guys. It's been brilliant. Okay.
Oh, yes. Thank you so much.
It's all about behavior. Okay, not about your behavior. You need to be emotionless, a heartless, fatherless child, my wife calls me. Okay. Okay, no emotion. Follow a simple set of rules and be patient and wait. Understand that behavior when you're in that trade. Understand the volume and the price action. What is the market doing? Not what fellow retail traders are doing on a Discord group or anything. What are the institutions doing to move or to change direction? And having that volume, it's a free indicator. Click on that link, because I am not showing that link on a slide unless
I put it up 3 or 4 times, and I put it in the main questions.
The only people who get it free who have attended live or get the link in the replay.
Awesome.
So that's it for today. Thank you very much for having me.
Pedro and Eric say thank you, Paul. Thank you for all you do.
Thank you very much. Pedro's in our, I know Pedro, he's in our Discord group. He is a hot oil trader.
All right, well, thank you for being with us. We're going to, you're going to be sending out email to everybody, and everybody here, click that link and go check it out, because this is a great offer. So I appreciate you doing that for us, Paul.
Thank you very much. I'm going to go and have a whiskey now.
Have a good evening, and thank you so much. Bye-bye now.
Bye-bye.
All right. Wow, guys. We have, that was Paul Bratby of Global Trading Software. Wow, right? So take advantage of that link that's in the chat, and you'll be able to sign up for that program free, which he doesn't ever do. And now I'd like to introduce to you our final speaker of the day, Eusebio Nanni of Max Trading Systems. He's going to be talking to us about how to build a trend following strategy. And I always like it when you're here, sir, because you are a well-known and highly respected trader with over 38 years of experience in Forex, futures, stocks, and options, plus 15 years in the banking industry. He has not he's not had a losing day of trading in the past 4 years, and his record of profit taking and insistence on strict risk management have brought him wide recognition as a world-class trader. So we're really happy that you agreed to join us. And let me make you the presenter. And let's just make sure, can you unmute yourself? You're self-muted, so you'll have to unmute yourself. I see your screen. There we go. What time is it where you are? You're overseas as well, I think, right?
Yep.
Are you in Spain?
No, I'm not in Spain, Sherry. I'm a Belgian trader, but I live in France for many years now. It's a country I love.
Well, this was our European live strategy session because Paul was joining us from Spain.
That's fine.
So we're really happy you're here, and take it away. I'll just be quiet now, and you let me know when you want me to post your link.
Okay, thank you very much, Sherry. Hello, everyone. Welcome to this presentation of the max trading system, or how to build a trend. We are using to define, in fact, the max trading system. So just before starting that, a small disclaimer, a quick disclaimer. So this presentation is for education purpose only. We do not provide investment or trading advisors. Investing and trading always present risk, so do not invest on trade or trade money you cannot afford to lose, and past performances are not indicative of future results. So a few words about myself. So I am a max instructor since 2009. And I am a full-time trader with the max trading system since 2008. But I am interested in trading and investing in almost all the financial market, the forex market, the fusion market, the stock and the option market since more than almost 40 years now. And I am a past software engineer, having practiced that career for around 30 years, and the last 15 years only in the banking industry or sector. And I have had the opportunity to work with a lot of professional bank traders, so with what we call the big boys. So that being said, so I just want to add a small comments about 2 points from some previous presentators. So in terms of mindset, the mindset is indeed an important aspect in trading, because there is always a psychological aspect in trading. What I do myself, I do not practice meditation as Norman Hallett advises, but something which is close to meditation. And for example, in my preparation steps every day, because I am a day trader, I take 5 to 10 minutes to relax, to sit comfortably. I close my eyes, I take a deep breath, and then I figure out mentally a trade, applying in a strict way, in a disciplined way, the rules the max provides us with. And so knowing when to open a trade, when to add to a trade, how to control the risk, and when to exit the trade. And so I figure out mentally a trade in such a way, it is a mental rehearsal. In such a way, I'm completely ready when I face my screen with my chart. And concerning the 90% losers, so I would like to bring a small nuance, which is especially dedicated to the forex market. It's true that 90% of traders lose even in the forex market, but we need to be a little more accurate. In fact, the real statistics exhibited by the BIS, the Bank of International Settlement, which is the bank of the central banks, which makes a survey every 3 years among all the regulated brokers. So they established that 90% of the beginner traders who opened an account for the first time will lose 90% of their money within 90 days. So this is what it is known as the 390% rule. And over the last 20 years, in fact, among the Forex retail trader, we have seen an increase in the number of profitable traders up to around 25%, which is probably due to better quality educations for many of them. But this means that there are still 75% of losing traders in the Forex market. So globally, I completely agree with these statements. So now, what I'm going to present today is how to define a trading method. I will show the different steps we consider, and then I will go into more details in these steps, and then a quick offer about what we propose. And so we consider that to build a trading process, a powerful, efficient trading process, we need to develop skills on 5 pillars. First of all, we need to have a trading method. Then with the trading method, which is essentially a technical analysis based system, we need also a trade risk management and a money management, a serious one, in fact. Then we need to understand the global context which drives the market. There are some major factors driving the markets. It's false to believe that the market behaves randomly. The market behaves in a very specific way depending on some important driving factors. And I will talk a little bit about them. And then the importance of the psychological mindset. Of course, we need to have the right mindset to trade. And a lot of points pertaining to the mindset has been mentioned so earlier. And then we need an organization. An organization is also very important because we have to define how to organize, for example, our preparation day steps. We have to define how we will monitor the instrument we want to trade, how we will execute our trading process, how we will make our debriefing session after the trading session, and so on and so on. And today I will essentially focus on the trading method development aspect. So the best way to make profit when we trade the market is essentially to trade trends. And years over years and years, this claim is proved again and again. And so the first step when we want to define a trading method is, of course, to define what a trend is, and inside a trend, what the movements are, and what are the movements we want to trade. The second step is to define when such a trend or when such a movement inside a trend will start. And we will do that especially through an entry pattern or an entry setup pattern. Then having an entry setup pattern is not enough to have a trade. We need to validate that entry setup under several types of conditions. The technical analysis conditions, which is the pattern a correct pattern? Are there counter indication to avoid taking that trade? Then we have to validate that setup with the global context. Is that setup in agreement with the global context? We have to define the risk we will take on that trade, and is the risk worthwhile to be taken or not? If it is not worthwhile, we will have to skip that trade. And then, especially in day trading, we will have to consider other conditions, for example, what I define as critical time period. We observe day after day that when we have the London Open, when we have the US Open, when we have the Wall Street Open, or when we have the London close, we have specific behaviors in the market, for example, an increase in the volatility, an increase in the volumes, and so on and so on. Once we have a validated setup, then we have a trade, and then we need to open the trade, and then we will have as the next step to handle the trade until its completion. And because as a trader, our main task is to assess a risk and to take a risk, because in order to make a profit, we have to take a risk in the market. We will have to control that risk and to progressively reduce and possibly cancel entirely that risk, at which point we will be in a risk-free situation. And when we are in a risk-free situation or in a break-even trade, then we can consider how we can optimize the profit from that trade. And then the last step we have to consider when we have to build a trading system is to define when a trend or a movement inside a trend will possibly exhaust or reverse. And I say possibly exhaust or reverse because the fact that a trend comes to an end does not necessarily mean that the trend will reverse. It may pause for some time and then resume later. So let's see now each of these steps in a little more detail, and I will bring a chart as an example, one or several charts depending on the point. So There are several ways to define a trend. So common ways is to consider, for example, in uptrend, the higher highs, the higher lows. In a downtrend, the lower lows, the lower highs. We can use also moving averages. We can use specific indicators. And for example, so on a chart, this is a chart, for example, on the pound US dollar, the pair is not important in itself. It is just to illustrate the process. So we can define at some point a low, then a high, a higher low, a higher high, a higher low, a higher high, higher low, higher high, and so on until the pattern is broken. And of course, when the pattern is broken, for example, in the two yellow squares, in the first yellow square I have drawn on the chart, the question is this previous uptrend reversing? This is not necessarily the case because we may have a complex pattern break. So we may have a succession of lower highs, lower lows, which is not necessarily a downtrend before the trend resumes. And sometimes it's not so easy to define that a high and a low will be respectively a higher high or a higher low, worthwhile to be mentioned. So this is not a perfect system to define a trend. But there is no perfect system. Each system has some disadvantages. A second system is to use a set of moving averages. We can use a long-term moving average, we can use a medium-term moving average, we can use a small-term moving average, short-term moving average to define, in fact, the quality of the trend by defining that concept of angle, separation, and correct order of these moving averages. We can use simple moving averages, we can use exponential moving averages, we can use any kind of moving averages, in fact. And then we can study the behavior or the relationship between the price behavior and the behavior of these moving averages. And we can even show that when we use such a set of moving averages, if they are chosen appropriately, these moving averages, or some of them, are showing what is happening in the instrument in higher time frames. And we show that clearly in our courses. But we can use a more elaborated approach to define a trend. So we have an indicator here, which is called the companion bias indicator, this green and red indicator, which indicate a technical trend. And it is called also the slow bias. When the slow bias is green, we have to take only long trade. When the slow bias, is red, we have to consider only short trade. And inside a trend, we may have one or several movements. For example, in these two, in this uptrend, this is a unique uptrend, we have two up movement we can trade, and in this downtrend, we have two short movement we can consider to trade. So now, once we have defined what a trend is and what the movements are in this trend, we can define, in fact, our entry setup, which represent high probability patterns. When such a pattern appears, we know that we have a high probability that the trade will move in that direction. And when I say high probability, I mean a probability of around 70 or more %. And for example, here in this down movement, we have here a pattern which we call a safe and perfect mo. Mo means a momentum entry. I will not explain here why it is called the safe and perfect mo, but this red candle is our setup candle, fulfilling all the conditions to define that high probability entry setup. And in this case, a short entry setup because the trend has turned to the downside. Basically, the setup, as I have said, is a pattern. And we have several types of patterns at the beginning of a new trend. And we can use many techniques about price action to define such an entry setup. Later along the trend, we can define other patterns to define other entry setups. And so in our trading system, the macro trading system, we have 7, 8, or 9 different entry setups to jump into a trend either at the beginning of a trend or later in the middle of the trend. Now, having such an entry setup, which is a technical entry setup, is not enough to have a trade. We have to consider, or we have to validate that trade So also with the global context. So what is the global context? Let me show you here quickly what we do. So here on our website, the mactrading.com/newswatch, which is a page of information which is free. Everyone, Max members or not, may access that page for free. And so on this page, we update that page every week. If you want to be informed when the page is updated, you can specify here your name and an email address. And so we specify, first of all, a set of events, geopolitical events, which may have an impact in the market if one or several of these events will evolve positively or negatively. So the geopoliticals are important factors in the market. In this section of our page, we also include some important decision by the central bank, for example, because the central bank have also a major impact in the market, especially when they have their meeting to fix their monetary policy and their interest rate, but also for their daily operation, because the central banks also operate in the market on a daily basis. Then we have a simplified economical news release, where we consider only the news release which may have an impact in the market, especially in the Forex market. Every day we have a lot of news releases, but many of them have no impact in the market. And so we focus only on those which are really important. For example, today we had essentially the Bank of Canada meeting with their rate statement and their overnight rate. So, and then we define also, because we want to define a trend following system, we define the best trending pairs which are worthwhile to be traded. In order to trade nice trend, it's better to choose the nice trending pairs. And then when we match these trending pairs with the news releases in an economical calendar, so we can specify for each day of the week what pair we can focus on priority. For example, today, good pairs to consider were the pound CAD, the US dollar CAD, the euro CAD, the pound Kiwi, possibly the pound yen, the euro Kiwi, or the pound US dollar. And of course, also other market, because we can, with the market trading system, we can trade the stock market, the indices, for example. We can trade the futures market, we can trade the commodities market, whatever the market, whatever the time frame, depending on the trader's constraints. So once we have made that, we define the global context. The global context will tell us in which direction each specific instrument must be traded in priority. And then we have to define the risk we take on that trade. And there are possibly other conditions, for example, taking into account what I call critical time period, especially in day trading, as I have mentioned earlier. And for example, so here, the euro Kiwi a few days ago, we had the safe and perfect mode short entry setup. We define our stop loss. We always have a stop loss. The stop loss gives a risk in terms of pips, but we have also to define a financial risk. The risk in pips is not enough. We have to define a risk in terms of, for example, a percentage of the trading account. And then we have to take into account the global context. So when analyzing the global context, that day the conclusion was we have to privilege short trade for the euro Kiwi that day. And indeed, in that case, we take only short trade when the slow bias then is red. And the slow bias in this approach helps to time the entry. So we had a first trade and then later a second trade. This is how we open a trade which is validated on all these aspects: the technical aspect, the global context aspect, and the financial risk aspect, and taking into account also this critical time period. This is why I always draw on my chart when we have the open and the close of the sessions, especially in the Forex market. So, for example, the Tokyo Open, the Frankfurt Open, the London Open, later the US Open, the Wall Street Open, and then the Frankfurt and the London close. Once we have opened a trade, we will have then to handle the trade in order to progressively reduce the risk or cancel the risk before considering to optimize the profit. And we can optimize the profit in several ways. We can, for example, at some point bank some profit. We can adjust our stop loss. And if we use a more elaborated trading method like the max, we can add to our trade in order to progressively build a larger position in order to extract more profit from the trade. And for example, here, so after having made the entry, this combination of candle here is an exit setup bar, and for the exit setup bar we can define a lot of technique. We can define exit setup based on pure price action. We can define exit setup based on usage of indicators, for example, momentum oscillator indicator. We can use a combination of both. We can use special time period during the day. So there are several ways to define exit techniques, and we have exit technique for short-term and we have long-term exit technique. A short-term exit technique always calls for a partial exit. We call it a momentum exit. So in fact, when we open a trade, we consider the trade is made of 2 units, and when we make a momentum exit, we close 1 unit, keeping 1 unit open for catching more profit if the trend continues to unfold. And of course, in the meantime, we will adjust our stop loss to reduce also the risk. And you can see that in this case, soon after that partial profit and we make that stop loss adjustment, the trade is risk-free and even profitable guaranteed trade in such a way that at that moment on the psychological level, we are completely relaxed, in fact. And at that point, we have 2 possibilities to close the trade. We can close the trade, like in this example, on the next exit setup, or as I will illustrate later, we can stay in the trade as long as the trend stays valid. So in this example, I have closed the trade on the next exit setup, making a first profit of 0.7 to 1, rework the risk ratio. And later I had a second opportunity to open a trade following the same process, a partial exit and then a final exit, catching an additional 1.9 to 1 rework the risk ratio. So 2 trades, 2 profitable trades, and there was also there was no other available short trade for the rest of the day on a technical point of view. So a nice 2.61 to 1 rework to risk ratio with a risk of 2%. For example, this would represent a 5.2% profit on the trading account. Of course, we have to define also, in some circumstances, I have said that we have the possibility to stay in the trade with the second unit until the trend reverses. And so this means that we need to define when the trend or the movement inside the trend will possibly exhaust or reverse, or we may have a special event, for example, like news releases. So our rule is to never stay in a trade when we are facing a news release. And so I will illustrate that concept with a scaling technique. So in our max standard trading system, when we have appropriate conditions, and if the risk is appropriate, from time to time, we can make a scaling, meaning adding to our position. We always mention by SC1, SC2, SC3, SC4, and so on, when we add to a trade. These are called scalings. And so we will have successive or several successive partial exit we will call scale out. And you can see in this down movement, we have a unique trade with 1 initial entry, several scalings, several MX. Up to that point, we have been able to stay in the trade until this moment when the trend has reversed and we get a long entry setup. And so when we get a long entry setup, the entry of this potential long trade will represent also the exit of this short trade. But now, because we have been able to stay in the trend as long as the trend was valid, and making the scalings and the successive scale out, we are able to catch a much more important profit, in this case, a 9.74 to 1 rework to risk ratio. With a 2% risk, this would represent a 19.5% profit, 19.5% profit on the trading account. When we ignore the scaling process in the previous slide, so here with the max primer, with only 2 trades, we were able to make only a 2.6 to 1 rework to risk ratio. So we can see that with the scaling process, provided we control the risk, this is extremely important, the risk must stay reasonable. So we multiply the profit by some factors between 30% and 300%. This is an example with the stock market and especially an index. And I have taken the S&P 500. So it was a few days ago. Again, this time, the context that day was to trade long the stock market. And so we had similarly an entry setup fulfilling the pattern required for the entry setup and all the other conditions, the technical conditions to define the entry setup. Then we had an appropriate risk. And then we were taking that setup in the direction proposed by the global context. And then we have been able, after a rather quiet behavior, been able to take a partial profit and then make only 4 scale-ins and then several MX partial exit until the final exit when the trend has reversed. And again, the trade has been closed with a short entry setup in this case, catching a nice total of 98.5 points in the S&P 500, which represent an 8.2 to 1 rework to risk ratio. The max primer without the scaling technique would have produced only a 2.58 to 1 rework to risk ratio. A last example I will take is what has happened yesterday in the, for example, in the stock market with the Dow Jones, with this nice drop, which has been also illustrated previously by the previous presenter. So a nice short global context, a nice short entry setup, only 2 scale-ins. And this was a remarkable movement with a fast acceleration, and until almost the bottom of that movement, no exit setup. So we had some nice opportunity to scale in without exiting the trade. And in this case, if we adjust correctly the stop loss along the movement, we can be very quickly in a risk-free situation and catching even a nice guaranteed profit. And when the exit has been made again at the trend reversal with a long entry setup, so the profit has been a nice profit of 1,559 points, which is an amazing result for the Dow Jones, representing a fantastic 32.48 to 1 rework to risk ratio. Even with the max primer ignoring the 2 scale-ins, so having the 2 same exit, this trade has produced a 12.27 to 1 rework to risk ratio. And so we can see that when we define a trade plan and when we trade the plan, so the trade plan must contain all the steps I have previously considered. So we have a very powerful trading process, a clear trading process. And when the trader follows strictly the rules of this trading plan, so it will become profitable. And the key point here is not necessarily to become consistently profitable, but to focus on the way to apply the trading process in a consistent way. And the key to success is there, being consistent in the process application. If we are consistent in the process application, the profit generally follows. But we can go in many more details, and of course we go much more into the details in our courses, and I will show you in a few minutes what are the offers we propose. But let me go quickly on some charts. So here, so with today, what has happened today, I will consider first of all the futures market. My bias was short today with the global context. So there were only 2 short trades, a nice one here and another small one here. This one was impossible because we had rules preventing to take that trade. In the Forex, when we have a big candle, this is not necessarily indicative of a big momentum. In the Forex, we observe for years and years now that 2 out of 3 times a long bar is followed by a pullback, and very often a deep pullback. So this was the pound US dollar. So down a short context 2 profitable short trade. If I take the Euro Kiwi, similarly, my context in this case was long, and so 2 nice long trade. If I take the Euro Aussie, my context was long, 2 nice long trade until the London close. The pound US dollar, the context was short, a nice short trade, which can be easily timed with our set of indicators. The pound Aussie, the bias was long, so 2 nice long trade. And I never mind if I miss such a nice short trade, because this down movement is not in agreement with the global context. The global context takes into account the driving factor established by the big boys. The big boys being the institutions, so the big banks, the big hedge funds, the big traders, and so on. I do not want to trade against them. So the pound card, especially with the Bank of Canada meeting today, so 2 nice long trade, one during the morning of the European session or at the beginning of the European session, and one just after the Bank of Canada release. They have kept their monetary policy and accommodative monetary policy unchanged, and their interest rates unchanged. And so this has weakened, obviously, the CAD. And so there was a nice long opportunity with the pound CAD. So the S&P 500 today. So again, the context was to short the stock market and 2 nice short trade in the S&P 500. So this is for the stock market. And if I consider the commodities market, I will consider, for example, gold. So here, gold, my bias was short for the gold, and we have seen today a nice short trade, a nice down movement, easily handled with our slow bias. And it seemed that approaching the end of the day, there was another short trade available, but this is not a time when I'm used to trade. My trading session is usually between the Frankfurt Open and the London Open, when in the Forex, especially in the Forex, we have the best opportunities. Sometimes during the Asian session, when we have main event around the Aussie, the Kiwi, or the yen, of course. So these are some examples. How do we define the global context? So I have mentioned previously the different steps I take into consideration. So the central bank decision or daily operations, the geopoliticals, the news release, and in day trading some critical time period along the day. And then for that, every day for our members, so we establish a list of bias, directional bias, we call max advantage bias. First of all, I make some comment we have to pay attention, and then I establish for a certain number of Forex pairs, some indices, some commodities, gold, crude oil, the bonds market, the US Treasury bond, the Euro bond, and also the stock market volatility with the VIX. So I establish, based on my analysis, so a directional bias. Green up arrows represent upward bias, so we have to favor long trade, and red down arrow represent short bias. We have then to prefer short trades when we have such a directional bias, and the bias can possibly change several times during the day depending on the market sentiment. So this is how we provide to our members who do not have the time to make themselves the global context analysis. We provide them with these information. And so all these points I have illustrated today, how to build a trading system. And in future presentation, I can go deeper in the other aspect of the approach. But we can go many more in details in our courses. And so we have several types of courses providing or insisting in the confidence in the way to develop your skills in trading, skills which must be developed in order to build several levels of confidence in the market, in the way the market provides everyday opportunities to trade, confidence in the trading system you build through the process I have just described, and confidence in yourself, in your ability to apply the rules you include in your trading process with patience and discipline. You have perhaps observed that in every chart I present, and this is what I also do in every chart I use to trade, I always have this small mantra displayed on my chart: patience and discipline, just to remind me that I have to focus on my rule. I have to stay patient. Staying patient means I need to wait for all the conditions to be fulfilled before taking a trade. A great temptation for many traders is when they sit in front of their screen and they open their chart, they want to open quickly a trade because of the fear of missing opportunities. No, we need to be patient, sometimes long minutes, sometimes like myself, because I am a full-time day trader, long hours. So when all the conditions are fulfilled, then we can push on the trigger. And with discipline, because we have to apply the rules in a strict way without never deviating from the rules. And this is what I call being consistent in the way to apply the trading process. And for that, with the course, we also provide not only mentoring to help our members to apply that process correctly, to fit that process to their own constraint. For example, not everyone will be able to day trade. Some will have to consider higher time frames or to use a more detailed approach with one of our max level. So we provide also that kind of confidence in skills development through the homework. After each training session, we assign a homework to our students in order for them to show us that they have understood what they have learned. And we have free workshops. Every Saturday, we have free practice sessions to focus on one or several specific aspects in this trading process. So the two courses we provide you today as a proposal are our two flagship course, what we call the Max Standard course and the Max Primer course. The Max Primer course is a very simplified approach with very simple entry setup, very simple exit setup, and a simple trade risk management and money management. The Max Primer level is profitable. It will take more time to grow an account, but it's still profitable. So, but it will give you an opportunity to test if we are legit in teaching how to trade in the market, and to give you an idea what the max may be. And then the main course is what we call the Max Standard course, with all the techniques I have explained, I have illustrated today, especially the scale-in and the scale-out technique and the trade risk management aspect, which is an important aspect so in trading when we achieve, for example, a risk-free situation or a guaranteed profitable situation. We have two other courses which goes much more in the details of some concept, like the Max Advance and the Max Sum course, but it is out of the scope of today's presentation. The standard course is made of 7 sessions, even 8 sessions. There is a bonus session spent on 8 weeks. So it proposed all the entry setups and the exit setup I have mentioned. It is a very high profitable system, especially with the acceleration process, which is the scaling technique, and a very simple but powerful trade risk management and money management. I make the distinction between the trade risk management and the money management. These focus on one specific aspect in trading. So the trade risk management has focuses on the way to handle a trade and how to control the risk along the trade, and the risk management focuses on how to grow an account. The primer course contains only 2 sessions with a bonus session with basic entries and exit. So it is, as I have said, profitable and with a simple risk management system. So, and so of course, today, for those who have been present today or who have enrolled, who will watch later the video, we propose a discount for the course. So you see the price here. If you want more information, so for our trading system, you can contact us So we have our email, support@mactradingsystems.com. We have even a Skype, so you can Skype us and we will be glad to give you any complementary information you would like to have. So this ends my presentation. So now I'm open if there are some questions. So
We do have one person, maybe you could like give it in a nutshell of how to build a trend following strategy, because I'm pretty sure your whole presentation was about that. But we
yeah.
still have someone who's asking, maybe there are some concise point 1, point 2, point 3 that you could just repeat for them.
Yeah, indeed. So let me go back some page backward. So there are, in fact, we consider there are 5 steps we have to follow. First of all, we have to define what a trend is. And inside a trend, what the movements are. Because of course, when we consider, for example, here on this chart, this uptrend, this is an uptrend, which is defined by our slow bias indicator. At some point, we may have a pullback or a down movement. And the problem is this down movement a downtrend or not? It is not a downtrend, it is a pullback. And so we have 2 movements inside this uptrend. The next point is to define what an entry setup is through some patterns. And when we recognize such a pattern, we have a potential trade opportunity. This does not mean a trade. To have a trade, we have to validate that pattern under several types of conditions. Is the pattern correct? Are there possibly counter indications? What is the global context? Is the trade, the potential trade, in agreement with the global context? Is the risk we associate to that trade worthwhile to be trading? For example, if we have an entry setup and following the rules to place a stop loss, we have a too large stop loss, for example, 80 pips or 100 pips stop loss, this means that the risk is not worthwhile to be taken. And then other possible conditions we can add, especially in day trading. When we have all these conditions being fulfilled, so we have to define what all these conditions are, then we have a trade. We have to define how to handle the trade. And handling the trade means, what do we do while the price is and the trend is unfolding to take a partial profit, to adjust the stop loss in order to progressively reduce or cancel, eliminate the risk on that trade, especially if we apply for our entry setup a scaling technique. And then when we are in a trade, as long as the trend unfolds, we can stay in the trend. We do not fix target profit. We want to extract as much profit as possible from the trend, but then we have to define when a trend or a movement inside the trend will possibly exhaust or reverse, in which case we will have to close the trade. And what I have illustrated here is when we have an entry setup in the opposite direction. And so if you follow these 5 steps to define a trend following method, you will define a powerful trading setup. And then you will have to apply that, to include that in your trading plan, and so to apply that trading plan and get profitable over time. You will not always have winning trade. It's impossible to have a 100% winning trade. What we obtain with the Mac trading system when we ignore the global context, we have a 70 to 75% winning rate. But when we include the global context, if you want to say that if you filter all your entries up with the global context, you will get a 90 to 95% winning rate. So these are the steps to build a trading system, a trend following system, sorry.
That's fantastic. I've got some kudos for you. Great presentation from Eusebio. Very useful. He's a trader and not a salesman.
Thank you very much.
That's from Tiago. And from Paul, I just wanted to say I have observed Eusebio a few years when he was still trading in Belgium, and I consider him the best trader I've ever seen in my over 40 years of trading.
Thank you very much.
Let's see, one more. Anthony says, student of Eusebio the Great, highly recommended. Thanks much.
Thank you very much. I really appreciate it.
Well, I've just got to say, this has been a fantastic day. I think this will be one of our most rewatched get-togethers we are going to have on board. I did post your link in the chat a
Yeah.
couple of times, and I put your email address there.
Perfect.
I really appreciate you being with us.
Oh, I appreciate to have been proposed to make such kind of presentation, and so yeah, thank you to you, Sherry.
Well,
We
I appreciate you
really at
staying
the
up so
Macro
late
decision, we
with us.
really appreciate.
All right, well, folks, that's it for today. I just want to thank all of our presenters and thank you for attending and being here with us. And I hope you share this with someone you know that wants to be a better trader. And Eusebio, have a wonderful evening. And this is Sherry saying trade well.
Thank you very much, Sherry. And so keep safe, stay tuned, and take care. Bye, everyone.
Bye, everyone. And that was Eusebio Nanni of Max Trading Systems. And he was talking with us about how to build a trend following strategy. And this has been a presentation of tradersexclusive.com. We have our Twitter at options_info, and there'll be a replay posted in the next little while. Have a wonderful day.